U.S. is leading. And this is one reason we remain overweight U.S. stocks.
The U.S. dominates in relative space. It dominates almost regardless of what the global scenario is.
I think that we are in the midst of a game changer on technology.
The bar for earnings to surprise to the upside has risen.
For now, the economy is certainly riding the wave of the increase in the stock market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Things settling down over the last 24 hours, just a little bit as we work our way through the middle of the trading week. Equities a little firmer, the bond market a little calmer, if we can call this bond market calm. Breaking through some interesting levels once again yesterday, through 5% for the second time in about a week. We back away. We're down 4 basis points at 494.92. On a 10-year, down 3 basis points at 463.66. Lisa's been talking about this for a while. Are we up here for the right reasons or the wrong reasons? Let's turn to the fund manager survey from Bank of America. The most bullish FMS since January 2022. The biggest jump in global growth optimism since May 2020. And Lisa, a record jump in allocation to commodities.
So we've been saying, are you full bull? And this fund manager survey has the headline, pretty fully bully. It also talks about, as you talked about, the most overweight commodities going back, the record jump in respect to allocation of commodities. This is the setup to yesterday and the day before. This is the setup to Jay Powell coming out and saying, it's been a little bit disappointing for us. We might have to wait a little bit longer. And the reason why people are seeing the potential for some sort of pullback, but nothing fundamentally shaking the confidence in this market.
The quote of yesterday for me, Bramo, and I'm not sure if you agree, perhaps you do, did not come from Fed Chair Jay Powell. Actually came from the Vice Chair, Philip Jefferson. And I'll share this quote with you now. My baseline outlook continues to be that inflation will decline further with, and this is the important line, with the policy rate held steady at its current level, at the current level. Our old friend TK would say extending the x-axis. The emphasis for them right now is on time, and it's going to take longer.
And right now, what you're seeing in markets is an extension. It is time. Remember how yesterday we were talking about what if Fed Chair Powell came out and said, I'm hopeful, I'm not necessarily confident. That was the subtext here, that essentially they are hopeful, but they are not confident, which is the reason why they're going to hold it longer and hold it higher for longer. And right now, the market's trying to come to terms with that.
I got that sense as well when he said the recent data hasn't given us the greater confidence, but we are expecting the confidence to come with more data. John, you mentioned the timeline, which makes me think that this is very political, because if they need more time, there's only a certain amount of data points left and meetings left before they could cut, before it becomes unfathomable in an election year.
Well, let's talk about the politics and the election year. This just moments ago, a little bit early this morning, President Joe Biden calling for higher tariffs on Chinese steel. This from Lael Brainerd, the NEC director. The president understands we must invest in American manufacturing, but we also have to protect those investments and those workers from unfair exports associated with, guess what, China's industrial overcapacity. Where is the president today? Where is he?
President's in Pittsburgh.
There we go. And what's he going to be talking about?
Tariffs on Chinese tariffs on steel.
Perfect timing.
Because he's talking to steel workers. You have to think when you see a policy like this, given how much of this kind of steel is in the marketplace, it's less than 1% of demand in the United States. So we're talking a little over $1 billion last year, that they probably looked at what is the president doing, gearing up for the election. Pennsylvania is a critical state. Trump and Biden have both won it in the elections that they won. And then you have to think they worked backwards. That's the event. What's the policy to appeal to this electorate?
So from the market's perspective, what do you read into this? Is it politics or is it markets? Is it inflation or is it containment of China and the export of goods? Which is it? Because if it's inflation, then you're not going to see tariffs like this go through in any kind of meaningful way that are actually going to be enforced. If it is really this idea of the economic competition between the U.S. and China, well, then you can expect stickier inflation. And this is the difficulty that the market's been having trying to reconcile some of these messages.
It's neither of them. It is purely politics.
It's purely politics. It's dominated and driven by exactly that, but it will have economic consequences. And a surprise, we're going down to Washington, D.C. a few hours from now, actually, for the IMF World Bank spring meetings. And this isn't a bigger issue. Who's down there in Washington right now at the World Bank, the IMF, talking up the benefits of free trade anymore? It just feels like everyone has thrown in on the towel on all of that just to get re-elected, because they know if they start talking about doing anything else, they will not win an election come November.
We also have been talking about this, though. How does the U.S. and the rest of the Western complex compete with the threat of China exporting cheap goods in a material way? Not only that, but how do they compete with the idea that China has unilaterally been funding a lot of other countries to exert its influence? We're going down to the World Bank, to the IMF, where they're going to be talking about joint cooperation at a time where China is going its own way. And China is the one country that nobody talks about. So I'm very curious to see how people address how this is going to shake out and what they're doing to potentially either get them on board or come up with some sort of cohesive strategy on the other side.
There is very little cooperation, and we'll try and talk about it through the week. Equity futures right now on the S&P 500 firmer by 0.4%. There's a little bit of a lift here. Yields are lower by 3 basis points, 463.66 on a 10-year. Crude backing away, down 1 full percentage point, 84.50 on WTI. Coming up this hour, we'll catch up with Lee Ferridge of State Street as Chair Powell puts rate cuts on ice. Sheila Kaiolu of Jefferies with a Boeing whistleblower set to testify on Capitol Hill. And we'll catch up with Ben Callow of Baird on Tesla's management shake-up. We begin with our top story. Fed Chair Jay Powell putting 5% yields back in play, admitting cuts will have to wait. Lee Ferridge of State Street saying this: if the Fed has not started to ease by July, we do not believe they will be able to cut in September. It will be too close to the election. The time frame for cuts is therefore closing sharply. Lee Ferridge joins us now for more. Lee, let's get straight to that argument. Why do you think the election matters that much?
Well, I think, look, if we were in the midst of a cutting cycle or a hiking cycle, then I think September is a perfectly live meeting. I think being within sort of 6 weeks of the election, you don't want to start a new cycle there. And this is why I'm saying, look, if they don't move in July, I don't think you start a cutting cycle in September. And that means that then we go to the November meeting, which is actually the day after the election. And that's why September really, for me, is very difficult for them to move.
Lee, it looks like the bond market's adjusted to that reality. We breached 5% at the front end of the curve in yesterday's session for the second time in about a week. The 10-year's getting closer and closer to 470. We're trying to figure out if they're up for the wrong reasons or the right reasons. If yields are up here because growth is really solid or inflation is resurgent, or both, and what that ultimately means for the equity market. How much competition is this bond market providing against stocks now?
It's starting to be competition. I think, to answer your question, I think 2 years are up there because of growth. I think 10 years are up here because we're getting worried about inflation. You only got to look at break evens. You can see 2 and 5 year have been moving up over the last couple of weeks as well. So, look, I think with the bond market, 2s and 10s are moving for maybe different reasons. But 10-year yields up here, we saw, look, we get towards above 4 3/4, 5%, then it becomes, a very real challenge for the equity market. Look, I still think as long as the curve is inverted, as long as the market still believes they're about to embark on a series of rate cuts, then equities can hold in. And at the moment, that's where we are. We've extended and pretended so far this year. We did have March, the start date of the cutting. Then we went to June, and now we're pushing that back again. But the important thing is the market still believes we are going to enter an easing cycle. As long as that's the narrative, equities and risk generally carry in FX, they can all carry on trading as we have been. Maybe it gets a little bit more challenging from here. I think it does. But overall, I still think the risk environment is positive, so long as the market believes cuts are coming.
Lee, how much conviction do you have that we're actually going to embark on some sort of rate cutting cycle? How much conviction do you have to get behind a risk on kind of feel at a time where things are looking a little shaky?
Yeah, my conviction levels on the whole cutting cycle have been limited for a while. Look, I worry that if Chair Powell doesn't get a cut in before July, I'm not sure we can get one this year. I worry about base effects in the second half of this year. I worry about the shelter component of CPI and PCE in the second half of this year. House prices are going back up in the US. PCE, shelter, and CPI owners equivalent tend to lag house prices by about 12 months. So that implies second half of the year, they start moving back up. Base effects generally are not supportive in the second half of the year. So the real risk is the second half of this year, inflation actually starts to move back up again. It hasn't come down as they hoped for in the first quarter when base effects were positive. And this is going to create a problem. So look, my confidence levels that we are about to enter a really prolonged cutting cycle are quite low, actually. Now, the market isn't there yet. The market still believes that we are. And that's why I say risk and hold in for now. But I think end of Q2, early Q3 is really when I'm starting to worry that the market's going to have some sort of rethink.
I spent a lot of time last night thinking about the dollar, especially in light of just what this means for other rate cutting cycles around the world. How close are we to a strong dollar starting to break things?
I think we're there. I mean, I think, I've been amazed. One of the things I'm most amazed about this year is the market's reluctance to price divergence. But we have a huge macro divergence, probably the biggest macro divergence in G10 that we've seen in decades. But the interest rate market has been very reluctant to price other central banks cutting before the Fed. It has no choice now. The S&P already went. The ECB have pretty much nailed on the June move, whereas Chair Powell yesterday obviously pretty much took that off for the Fed. So the market's almost been forced into pricing other central banks cutting before the Fed. And that's fine, because FX markets are still not moving that much. You look at where the euro is now, 106.5. Look, we're pretty much the middle of the range we've been in for 12 months or so. It's not as if we're at extremes in FX. Yen aside, yen is a different case. But for the rest of the G10, we're not really at extremes. And so therefore, other central banks should be confident to go ahead and cut rates as they see fit. Look, if the euro is getting down below parity, then yeah, maybe we should worry. If sterling is getting down to 110, maybe we should worry. But that's not where we are right now.
We also heard from Andrew Bailey yesterday of the Bank of England. Of course, he's going to be at the IMF spring meetings. He pretty much implied that they're ready to go before the United States. Is that your base case?
Yes, it is. I mean, this is why we have a negative view on sterling against the dollar, because when you look at what the rates market's got pricing, really the first Bank of England cut is September. Pretty much the same as where the Fed are in terms of rates pricing. That makes no sense to me. UK growth is negative. OK, US growth is almost twice trend growth. We're at 3.1%, going to be around 3% in the first quarter. Very, very different economies right now. UK inflation, even though it's a little bit higher than expected this morning, is now below US inflation headline for the first time since 2022. We are moving in different directions. The US is growing above trend. The UK is in recession. The Bank of England should be cutting before the Fed. There is no doubt about it. And yet the market still doesn't have that price. And I think that has to be pulled forward. And that's going to see sterling weaken. And I think you could also see euro sterling higher in that scenario, because we pull forward the ECB, but not the Bank of England in the same way.
Well, let's talk about some levels. You mentioned some. You talked about 110 on cable, parity on euro dollar. Lee, are you actively looking for those kind of levels to come back again?
No, not yet. Look, I mean, I think, I got caught out with sort of being too bullish on the dollar last year. We got down to sort of 105.5 on the euro, and I thought we'd go further, and then we just reversed. Look, I think the dollar over the next couple of months, it's going to struggle to make gains across the board, because we've now taken so much out of the Fed this year. It's hard to take a lot more out in the next month or two. Maybe we can in Q3, as I said. I think, then things could change quite dramatically. But right now, you're not going to see it. So it's going to be more idiosyncratic moves for the dollar, I think, in Q2, where we add rate cuts in elsewhere. So sterling is an obvious one, but 110 is a long way on that basis. Look, I think we can get down to 120. I think on euro, we could maybe get down to the 103 level, quite away from here, quite honestly. And given the ranges we've been used to over the last year or so, some pretty big moves, but not maybe to the extremes you're talking about. It's possible if the others, the other economies continue to weaken, the central banks get more aggressive, but they seem very wary of outcutting the Fed by too much. And that might contain some of the FX moves, but it's very hard to look beyond the dollar. Very hard to look beyond the dollar within G10 right now.
Lee, enjoyed this. It's great to catch up, buddy, as always. Lee Ferridge there of State Street. Bramo, well done for bringing up foreign exchange, because we've seen some big moves so far here today. And people like Lee think we might see some bigger ones. I think yesterday closing out on DXY at least, 106 handle, 6 days of dollar strength, longest stretch going back to September last year.
We talked about who cares most. Who does this sort of tie the hands of most? The Bank of Japan, the ECB, or I'll add this in, the People's Bank of China. Take a look at the yuan weakening and the fact that they are basically avoiding potentially cutting rates even more to avoid further depreciation of their currency. This is a massive issue for the other central banks, and it's got to be front and center.
What do you do if you're worried about tariffs? Weaken the currency, don't you?
Well, OK, so this is one thing, right? You weaken the currency and then all of a sudden you're exporting even more cheap goods. it gets hairy when you're starting to think about it.
I'm not saying that's what we're playing right now. I'm just saying it's an interesting dance taking place.
It could. That's sort of what Mohamed El-Erian was leaning at.
Right to bring it up. Dollar strength, big issue at the moment. Just a little weaker on the session. Let's give you an update on stories elsewhere. Let's get to your Bloomberg brief. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. ASML shares are lower in Amsterdam trading. Europe's most valuable technology firm posted new orders that fell short of analyst estimates. It was hurt by a downturn in demand for its most advanced machines needed to make high-end chips. ASML said it's expecting weaker than expected sales in the second quarter before demand starts to pick up. LVMH sales growth slowed at the start of the year. Revenue in its fashion and leather goods unit, which includes Dior and Louis Vuitton, grew just 2% in the first quarter compared to 18% growth a year ago. But shares are rising in Paris, trading amid relief from investors who feared results would be worse due to a worldwide slowdown in demand for luxury goods. And record rainfall in Dubai led to flights being diverted and cars being left stranded on flooded roads. The United Arab Emirates experienced its heaviest downpour since records began back in 1949. That's according to Dubai's media office. The government told its employees to work from home today and urged private employers to do the same. Schools have been directed to remain closed. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. So they've been seeding the clouds, is that right? They've been trying to make it rain more aggressively.
Wait, how are you coming up with a conspiracy theory about this? Is that really what happened?
That's not a conspiracy theory. That's what's been happening in Dubai.
Wait, so this is their sort of own doing?
I don't know how much of this is their own doing, but they've certainly been seeding the clouds. That's what they've been trying to do. They've been trying to generate more rainfall. And they clearly don't have the drainage for the rainfall they've been getting, which is obviously problematic based on what's happening at Dubai Airport.
Man versus cloud.
Yeah,
we'll continue.
I know.
Coming up next.
You should read about it. Anyway.
I will.
Okay.
It's a desert, so they need this water. But
up next on the programme, Boeing under scrutiny on Capitol Hill.
Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing.
That conversation up next, live from New York City this morning. Good morning. I love Abramowicz. Spent the whole commercial break reading about cloud seeding in Dubai. What did you learn?
It's fascinating. I mean, this is basically one of the contentions. Some people are saying that they might have conducted cloud seeding. They're saying absolutely they did not operate cloud seeding right before the torrential rains. But this is a real thing.
I'm surprised it hasn't been a bigger piece in the news cycle over the last day or so. I am surprised.
They've been cloud seeding since 2002, yet they haven't put the right drains in case cloud seeding actually worked. I mean, look at the airport.
It's amazing. It's amazing the amount of flights that have been cancelled as well. If you're over there, I hope you're doing okay. Equity futures on the S&P 500 positive by 0.4%. Small bounce. Yields are lower by 3 basis points on the 10-year 463.66. Under surveillance this morning, Boeing under scrutiny on Capitol Hill.
Of course, everybody in America is worried about what happened. Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
Here's the latest this morning. The Senate holding 2 hearings on whistleblower claims around Boeing's safety culture. Those claims prompting ongoing federal investigations, as well as a criminal probe by the Justice Department. The whistleblower is set to testify, but Boeing officials won't be present at either hearing. Present now is Sheila Kahyaoglu of Jefferies. Sheila, let's get into it. The claims, the allegations coming from whistleblowers, how serious are they? What's the big one for you?
With the 787 whistleblower, that's new news since the CEO has announced that he's stepping down at the end of the year. The 787 has been a fairly safe aircraft. What we track is production of the aircraft on a monthly basis and deliveries, and what we're seeing is at about a rate of 5 a month. So we feel a lot more confident in the 787, just given the track record. Also, bear in mind, the 787 at peak did 14 a month, is slated to go 10 a month. The 737 at peak was supposed to go to 50 a month. So just a lot more pressure on the production line to churn up those aircraft out at the door. Of course, the 787 is a bigger aircraft, but, it just the pressure of the volume really, really hurts.
Are we going to learn something today, or is this theater?
I think it is a little bit of theater, especially because you have had this management overhaul in place and the board changing as well. I do think it is a little bit of either. There was the NTSB with the Senate yesterday, and we didn't learn anything really new out of it, whether what happened on the Alaska flight or Boeing's safety culture. So I'll wait to see what happens today. But given that there's no Boeing executives, I don't think we'll hear much new.
Is that news in and of itself? The fact that we're so far after this happened, that we've really had so many questions, there have been more incidents, there have been lost orders, there have been increasing delays at certain airplanes. How much is that surprising that we don't have more answers, especially as the Department of Justice operates some sort of criminal probe?
Yeah, I think the FAA really has to focus on bringing safety back to Boeing and also the public perception. Everyone asks what's going on with Boeing. Kayak has a search function where you could choose what type of aircraft you're on. I guess I get endless Bloombergs from colleagues of, is it safe to fly this aircraft? I'm like, yes, it's completely safe. So I think the public perception is what we need to change now. And the new CEO, when they're announced, and no one knows how far that search is, has a lot of work to do, whether it's the safety culture, but also new technology, bringing that to Boeing and just overhauling the culture and also cleaning up the production lines a bit.
With the NTSB yesterday on Capitol Hill, do they see any evidence that things are moving in the right direction for Boeing?
To be honest, it was a bit backwards looking. We talked about the older the prior incidents that happened on the MAX. Very little was given on Alaska. So I think we're going to wait to see what happens with the FAA audit is now complete and what happens with the next steps. But that brings you to the summertime period, and we should probably see a new CEO in place by then. So I think Boeing is sort of in this purgatory right now where the FAA is still on top of them. We're only producing about 17 737s a month. We're supposed to be at 38. So we're at this very low production, and that brings us to airlines in a way. Capacity is very tight in the U.S. domestic market.
Well, two things to talk about. Let's talk about the CEO search, and then we can get to the prospect of deliveries picking up anytime soon. How big is the potential talent pool for the CEO of Boeing? Where do you find them? If you're a recruiter, who do you call?
The most popular question investors ask us every day. I think there's only a select few individuals for the job. It seems overall sentiment is for someone new, an outsider. We've seen it happen at GE 6 years ago. Larry Culp took over with a fresh set of eyes, dismantled GE, and GE Aerospace started trading as a public company at the start of April.
Is that the number we're dialing, 1-800-GE, Larry Culp extension?
It kind of is. I think, I think given his history at GE, he brings, a strong background to it. There are a number of people on the board, and there's also, of course, the other aerospace and defense executives as well.
Might be a few quarters until we get him. If we get him, I want to work out what happens with deliveries in between. Are we just going to sit at these levels and not pick up?
We've cut our delivery forecast from about 500 total aircraft, including, for the MAX, to 400. But the way we're trending right now, with only a handful of deliveries to start the year, you're going to see a lot more pressure on deliveries. And without, depending on when a new CEO is announced, I can't imagine he's going to pick that rate back up the first moment he steps in. What they're probably going to do is say, our $10 billion free cash flow target for 25-26 is out the door. We don't care about rate. We're not going to talk about rate. We're going to focus on quality. And once we hit those, we'll start increasing rate.
Does that mean we're going to be flying a lot of old planes just in the meantime because they can't get the new ones?
With the ashtrays in? I
actually went to the TWA hotel, and you can see the old one from
when you get on a plane and the ashtray's in there.
There's an ashtray. It's actually been made into a bar, but let's carry on. It's really cool, actually. I highly recommend.
I was speaking to the United CFO last night, and Michael Leskinen was talking about United was expecting a lot of new planes this year, but they're not getting them. So they're positioned to be a much bigger airline than they are. They have the headcount in place, but they're not getting them. They have to fly the older planes while they're trying to put up a premium product. So they're focusing on better Wi-Fi, better interiors, better food quality, but keeping costs down. So I think for now, the consumer is in a tight spot. And if you think about 100 aircraft removed out of Boeing's forecast to start the year, that's a big capacity reduction, 2.5 points of capacity out of the U.S. domestic market. That could translate into a big price momentum for the U.S. airlines, which have been suffering. U.S. domestic pricing essentially was flat year on year in 2023. Q1 saw some signs of improvement, the inflection we were looking for, but that the airlines hadn't priced in for. So in a way, the way to play this Boeing issue is through an airline and an aftermarket shop like a GE and a HEICO, while Boeing keeps their deliveries low. But it's bad for the consumer overall.
Given how this conversation's gone, all the more impressive that United did what they did after the bell yesterday. I think the stock is higher in the pre-market, Bramo, by 5%.
They didn't lose as much money as they can think. I'm just thinking, what are we going to say? Free Wi-Fi, ceiling optional.
Better food.
Better food.
Better food, ceiling optional. Sheila, thank you.
No problem.
Sheila Kaulu of Jefferies there from New York City. This is Bloomberg. Things just a little bit calmer. From New York City this morning, welcome to the program. Equity futures positive by 0.4% on the Nasdaq 100, up by about 1/4%. Doing okay on the Russell. The small caps up 3/4%. The Russell, though, has been absolutely hammered off the highs of the year. I think we're down something like 7% since those highs back in March. So it's been difficult. Let's turn to the bond market. 2-year, 10-year, 30-year, breaching 5% once again in yesterday's session, then backing away. Backing away again this morning. We're down 3 basis points. 495.35 on a 10-year Lisa. 463.66.
Fed Chair Powell said the quiet part out loud, that these were not just bumps in the road. 3 of them makes him uneasy. And that basically he didn't use the bump word, just to be very clear. But he did say that it does suggest that we're not making as much progress on inflation, and maybe they might let policy take further time to work, extending the timeline.
Yeah, the emphasis on time and just reinforcing the moves we've already seen both in bonds and in foreign exchange. So switch up the board and get to FX. We'll go through some currency pairs for you. The euro back to about 106, bouncing back today. Bit of yen strength on the board, but this has been dominated by dollar strength and yen weakness over the last few weeks. Lisa, dollar yen 154.60, and not really a peep out of the Bank of Japan, not really a peep out of the finance ministry in Japan either, because what can they do?
What are they going to do? Throw money uphill and hope that it doesn't come down? I mean, at a certain point, people are talking about 160 being a testing point for them because they cannot counter a strong dollar, given that they are not raising rates materially from here. What I keep asking is, when does the dollar break something? Because right now we keep seeing strong dollar at the same time that the rest of the world wants to start a rate-cutting cycle. How does that work if they're trying to support their economies?
I want to turn to sterling as well, Lisa. 124.67. Cable up about 1/3%. Inflation just a little hotter, just a little bit. But the pushback we got from Lee Farage of State Street about 20 minutes ago, Lee basically said, sure, inflation was a little bit hotter this morning, but inflation is running below where inflation is in the United States. The BOE is going to have to cut soon because the growth profile is so bad. And you should be expecting a stronger dollar against the pound here and against the euro and against basically everything else in G10.
And when does that become a problem? And that's what a lot of people keep asking. When does the dollar become punitive to some of these other nations that are trying to ease, that are facing slower growth, but are going to see inflation stay hotter if they're importing it from the outside? And this is especially prevalent with oil, if oil continues to climb.
That's the currency story. Let's get some top stories for you. Under surveillance this morning, Fed Chair Jay Powell put in rate cuts on ice. Powell saying this yesterday: the recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Today, we'll hear from more Fed speakers, including Mester and Bowman, and you get the beige book a little bit later this afternoon as well. I said earlier this morning that I think maybe more instructive, more direct, more blunt were the comments we got from the Vice Chair, Philip Jefferson, who really put the emphasis on time at current levels. It's that phrase, Lisa, at current levels, that I think is really important at a time where I'm not saying it was the consensus view or becoming the consensus view. There were just a few people asking how close we would be to a conversation about higher interest rates based on the communication we've had from Fed officials in the last 24 hours. They're nowhere near to having that chat just yet.
It seems like hikes are off the table. However, no cuts looking perhaps a little bit more likely at a time when there's clearly a split on the FOMC. I thought it was interesting, even as we heard from Fed Vice Chair Jefferson and we heard from Fed Chair Powell, New York Fed President John Williams is basically the resident dove in that triumvirate of Fed officials, saying that inflation has fallen across several categories over the past year and a half. So basically really pointing to that story. You can kind of feel the disagreement percolating under the hood.
Yeah, because but the problem is it's not broad, and they need that top line number to come down. We also heard from Richmond Fed President Thomas Barkin. He reiterated this a lot. The recent data, including the CPI, has not been supportive of a soft landing. So it's just wait and see. But the timeline, I think, makes this incredibly complicated for not just Powell, but President Biden.
More Fed speak coming later. Let's talk about President Biden calling for new tariffs on Chinese steel and aluminum products. The announcement coming ahead to a planned trip to Pittsburgh later on today.
Depressed.
The president asking for 25% duties. That was a direct quote. As part of a wider review. And will repeat that US steel should remain American owned. This was becoming an issue, Annmarie. It's becoming a bigger issue, and it's going to be a big one on the campaign trail, clearly based on the events today.
Absolutely. American owned, and we should pronounce it the American way. aluminum, not aluminium. Jonathan, I know you took a breath there to make sure you can get it correct. This feels very political, and we've talked about this earlier, because first off, if you thought this was such an export overcapacity of steel from China onto the U.S., you would have taken this earlier. And it's such a minute part of the demand. It's $1.7 billion worth. It's less than 1%. When you look at Chinese steel in the American market. So is this a top priority when it comes to China influencing the U.S. economy? Likely not, which is why it's a political issue.
Well, it raises this question about what actually is going to get done before the election if we have such conflicting messages coming out. I mean, honestly, this raises a question of what kind of baby will get thrown out with bathwater in the name of politics.
Tariffs on steel and tariffs on Chinese EVs maybe as well. Speaking of EVs, here's Tesla. The market value briefly dropping below $500 billion after a shake-up in management and a 10% cut in headcount. Ben Callow of Baird, still optimistic ahead of earnings next week, saying this: we think Q1 results will be messy due to several one-time items. On the other hand, the announced robo-taxi unveil and emphasis on full self-driving and energy business growth are positives. Ben's with us now for more. Ben, always great to catch up with you, sir. Can we just talk about how real you think this robo-taxi effort is going to be and how quickly we can see the money from that effort fall to the bottom line? How constructive are you?
So thank you for having me. I think that it is real. Now, there's so much skepticism in Tesla at this time. And we've seen this, over our coverage, over the past decade, periods like this, layoffs, key executives leaving, people thinking that, the robo-taxi is all smokescreen. I wouldn't have been against Elon on this. Now, does it show up in next year's numbers? I don't think so. I think it's probably a 26 story. That's why we value the company off of it. But I would be very cautious in thinking that this is something that is kind of vaporware. I do think that they put a considerable amount of both CapEx as well as R&D into full self-driving, into the robo-taxi. And I think that, we could be surprised on August 8th with additional announcements as well.
Ben, I think people were skeptical, and we can get into the prospect of additional announcements, but let's talk about the original reason for the skepticism. We've had some head fakes before, and this announcement came on the same day that Reuters had come out and basically said that the company was about to scrap the 25K platform, as you've written yourself in your most recent notes. Ben, what do you make of the timing of the announcement? How relevant is that?
Well, I think it's very relevant, and I think that, there's a lot of confusion that's weighing on the stock right now. I mean, we have, a couple key executives that, I think outsiders look as responsible for the lower price vehicle, call it Gen 2, call it Model 2, next generation. And people are thinking that that's no longer on the front burner. It's scrapped, or pushed back. There's all kinds of confusion around the different terms being raised. I would say that, both vehicles were always planned to be on the same platform right now. And so we have to wait to see till August 8th. In our view, they could both be announced at the same time and shown at the same time as well. And that could be a catalyst for the stock.
Ben, is the bulls and the bears, is the thesis on each side basically divided on who believes in Elon Musk and who thinks he's just a man with a number of good ideas, but in this case, this is a car company?
The question always is, is it a car company? Is it a tech company? Is it an AI company? Is it an energy company? And, my answer is yes, all of the above. Right now with results and the auto industry, EVs in particular in the U.S., having weakness, Tesla deliveries in particular having weakness in Q1. We think Q2 numbers likely too high on deliveries. It comes back to being an auto company and not getting any real credit for the work that they're doing in AI, the work they're doing in full self-driving, and definitely the work that they're doing in energy, which is showing up in results, albeit a smaller part than the auto business. So right now, people are viewing it as a car company. That's the biggest risk to the stock, is it starts getting valued as a car company.
What in actual production right now gives you confidence that it's something more, that there's going to be a turning point given all of the bearishness and the fact that we have seen its value fall below $500 billion for the first time in a long time?
A couple things. Number one, I think being able to attract the best talent and engineers out there. in many studies, SpaceX, Tesla is listed, top 5 of being able to attract talent. Number 2, the capital that they've been deploying, not just this year, but last year, the balance sheet they have to do that, even, with the weakness, we still expect them to generate free cash flow after deploying $10 billion in CapEx. I think a big chunk of that is going to AI and different initiatives there. And so, as they, discuss the different waves of growth, and, the next wave is going to take longer. And the risk also is we have kind of a flat to downish, 3 years in a row, and people start wondering, is this a growth stock? And I think we have to be patient for that longer term, 26 plus.
Ben, I'd love to ask you about the industry more broadly. I spoke to the White House climate czar yesterday, John Podesta, who admitted there's still some range anxiety out there because of the lack of EV charging stations. I think it's about 16 EV charging stations for every single gas station in the United States. Until that gets fixed, are we almost at peak when it comes to EVs?
Well, the U.S. is lagging China penetration. I mean, I think if you look at the China numbers, just in Q1, up year over year, over 30%. U.S. still growing. A lot of headlines suggest that there aren't growth in EVs. There has been a lot of pullback from the other OEMs. Ford, GM, still committed. Different timelines pushed out. At the bottom of it, though, Tesla's been very aggressive on expanding their supercharging network and opening it up to other OEMs, because it's still a problem out there. So often you can go to non-Tesla charging stations, they'll be broken, there'll be a long line, technology's not that great. Tesla's really leading the way in the U.S. in this, and I think that the work they're doing now will help with adoption in the future for not just Tesla but other OEMs as well.
Do you think we can ever see Tesla produce a hybrid?
No, I don't think so. If you look at the data here, and there is a consumer shift to these plug-in hybrids. One, just personally, driving one as a rental car, inferior product. It's inferior to a internal combustion engine. It's inferior to a pure EV in the way it drives. Number 2, if you think about it from emissions. And we don't really highlight that as much as maybe we should, but the emission profile is much worse than a pure EV. A lot of times people don't charge them, so they're just running off of gas.
Yeah.
And so there's a lot of data coming out now out of the EU and other places showing how the emission profile is bad, but it's just not cool to drive. And it's expensive to make, too. You're basically doing 2 powertrains on a vehicle. And so it's kind of a Band-Aid approach that I think is a mistake by a lot of OEMs right now.
Ben, as we've been speaking, we got a little bit of news on the leadership of Tesla. This is about Elon Musk. I just want your reaction to it, if we can get it. Tesla said it will call a vote on moving the company's state of incorporation to Texas from Delaware. We've been waiting for that. They're also going to ask shareholders to vote again on the massive compensation package that Elon Musk was awarded back in 2018 and that the Delaware court voided. Ben, can we talk about the leadership and what you'd expect to be the outcome from those kind of votes?
So, when we had a cautious approach when the ruling came out earlier this year, so the end of January, around the package, because Musk kind of said, I'm going to take my ball and go play somewhere else with the AI. Current investments stay at Tesla, but anything new, if I don't have 25% control, I don't want to do it at Tesla. And I saw that as a risk. I think that going back to that package and going back to the previous compensation package, when it came out, the bearishness around the targets was immense. People never thought they could hit these different targets. The different EBITDA goals, the different goals around the number of vehicles produced, and I think that even I was surprised, being very bullish back then on how fast they hit these targets. And I think he should be compensated that way. Now, does Musk do things that, alienate people or make people mad? Sure. Yes. At the same, I mean, there's no question about it. All the time, people, outside of investing will talk to me, family members, this, that. He's controversial. Same time, he's built several different, groundbreaking, revolutionary, whatever term you want to use, companies out there. And so, I think he's due some credit, a lot of credit, actually.
I think a lot of people might agree with you. Ben, thank you, sir, for the update. Ben
Thanks,
Canada
guys.
of Baird, thank you. Thank you very much. We've just had back-to-back conversations, one on Boeing and another on Tesla. And it's almost unbelievable that Tesla is down more this year than Boeing is. Boeing year to date, the third worst performing stock on the S&P 500, down a little more than 34%. Tesla down by close to 37%.
In fairness,
kind of amazing.
It is amazing. It also shows you where Tesla's come from and the fact that Boeing's been dogged with a whole bunch of problems for quite a number of years. But this issue of the hope and the prayer and the sort of confidence in the Elon Musk story has been prevalent until now, when it's actually been challenged with real delivery numbers, particularly out of China.
Tesla up this morning by a little more than 1%. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Yahira Hackers. Hey, Yahira.
Hi, John. UK inflation slowing less than expected last month, tempering bets for rate cuts from the Bank of England. Consumer prices rose 3.2% in March compared with a year earlier. While that's a drop from February and the lowest mark since 2021, it was above the 3.1% that the BOE and economists had expected. Traders have significantly pared back their rate cut bets in the UK and are now favoring just 1/4 point reduction this year. Morgan Stanley plans to start cutting about 50 investment banking jobs in the Asia-Pacific region this week. That's according to our Bloomberg reporting. At least 80% of the reductions will be in Hong Kong and China. The job cuts would be the deepest in years for Morgan Stanley in China, its biggest market in the region. And in an interview with Bloomberg, JP Morgan Chase CEO Jamie Dimon makes no secret that his firm is all in on artificial intelligence.
It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. Like, AI is doing all the equity hedging for us for the most part. It's idea generation, it's large language models.
You can see more of Emily Chang's interview with Jamie Dimon on The Circuit tonight at 6 p.m. New York time on Bloomberg Television, or stream it at 8 p.m. Eastern on Bloomberg Originals. That's your Bloomberg Brief. John?
Yahira, thank you. Congratulations to Emily and the team. I've seen the trailer for the new series. Very, very cool. Looking forward to that a little bit later. Up next on the programme, higher for longer.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence.
That conversation up next. Stocks on the S&P 500 firmer here, bouncing back just a little bit from 3 days of losses. We're positive by 0.5%. Yield to lower by 2 basis points, 464 after coming very close to 470 in yesterday's session. Under surveillance this morning, higher for longer.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us.
Here's the latest. Treasury yields touching year-to-date highs and the dollar seeing its best 5-day gain since October 2022. As Fed Chair Jay Powell signals rates could stay higher for longer. David Page of AXA Investment Managers expecting 3 cuts this year, starting in July, followed by 3 more in 2025. David is with us here in New York. David, good morning to you.
Good morning.
You're still a July guy, so let's talk about that. What needs to happen between now and then to make that happen?
Well, I think when we were looking at July and we made the call, we shifted back the call to July on the back of the CPI numbers. We were looking at the fact that the Fed was definitely going to need more time to see a fall in that inflation number come through. And I think, frankly, what we've heard from Powell yesterday is that time is probably going to be a little bit more. So I think we're probably thinking pushing back now to September, but only to September. But if you're going to see September, again, you still need to see this softness come through. And we're not seeing it across any of the metrics. And I think the biggest surprises have been retail sales and payrolls. Now, both of those are likely to soften, we think, over the next couple of months, and hence we still think that cuts are likely this year. But there is an uncertainty that's unfolding.
I can tell you how this is going to play out this week for you in New York. You're going to meet with clients. You're going to say September, and they're going to scream election in November. What are you talking about? Because we've had so many people push back against the prospect that they'll do anything in September because there is an election a few months later. What's your response going to be?
Well, we hear this every 4 years, right? There's this market mythology that the Fed will never move around an election. And actually, there's that sort of thing about the Fed worrying about the optics. If you look at the stats, you can never, ever see statistically any deviation in Fed policy to economic needs. It always moves roughly around a Taylor rule, regardless of when that election is. So that's not to say the election can't have an effect. Clearly, if markets think such and such is going to happen, financial conditions shift accordingly, they'll have to take that into consideration. But the timing of the election, we don't really think so.
So how do people push back given the fact that most people are not on the same page? I mean, basically, you do have a rate cut baked in by September, but it's shifting as days go on, further out in the year. What would you do differently if you also pushed out your expectation for the first rate cut to December or not until the beginning of next year?
Well, so then you start to see financial conditions shifting. And I think that's the real issue that we've got coming through here, that the Fed is trying to control the economy through interest rate policy, but the economy is probably much more sensitive than we've seen, much more insensitive than we've seen to interest rate policy for a while. And of course, it's financial conditions that are therefore transmitting that. So what you're seeing is financial conditions now shifting quite materially. And I think that's the important thing. The restrictive policy that the Fed wanted in place to try and bring inflation down was really undermined by the easing in financial conditions that we saw from October last year. And now we're starting to see the swing back the other way. So I think that starts to play on the medium-term driver. The short-term driver of rates is going to be inflation. We need to see a softness come through there. The medium-term driver is growth. And with financial conditions now starting to tighten again, and we suspect probably with a little bit further to go, that's going to start weighing on growth. Not so much over the next couple of quarters, but as we move into early next year, and that facilitates further rate cuts beyond.
Don't we have to see further softness in equity markets and even in credit, and we've seen that to some degree over the past couple of trading sessions, in order to get inflation back down to some sort of level that gives the Fed confidence to cut rates? In other words, aren't rates going to remain in this level until you see something crack in markets?
Yes. I think so. And that's the movement in financial conditions that I think we need to see. So, I mean, we have to think that the softness in financial conditions came about with markets incredibly looking for sort of 7 cuts at the height of last December, which always looked unrealistic. Now we're probably going to move a little bit further in the opposite direction. Markets pricing out the prospect of 2 cuts even this year now. And that is having an impact coming through on the rest of the space. But you need to see that come through, to see the softness come through. The easiness of financial conditions probably has helped boost consumer spending over the first half of this year. You probably need to see the swing move back the other way.
There's one issue where you are in complete disagreement with the Federal Reserve, and that's on so-called R-star. Can you just walk us through that as a theme, why you have this big sort of disagreement with where the Fed is at and where you're at?
Yeah, certainly. I mean, the Fed has kept its measure of R-star effectively unchanged since the lows of the GFC. So it sees 2.5, 2.6 now as the long-run Fed funds rate, which is effectively 2% inflation and 0.5% in terms of R-star. To our minds, the R-star level, very hard to define, very hard to pin down. But if you look at what we see in terms of advanced trends in advanced economy growth, they have picked up markedly since the lows of the GFC. We would expect growth trends to be markedly higher over that period. And when we think about the US, there are very clearly some short-term dynamics that see that trend growth a little bit higher still. So we think it's quite natural to see R-star move from the very lows that we saw at the back end of last decade, and we're looking at them being about 75 basis points higher. So we think that R-star is probably around 3.25, high confidence margins around that, obviously, but higher than that 2.5%. Now, that's not particularly controversial in terms of the market. The market also has that sort of price in place, 5 years up even higher than that still.
Yeah.
So we do think that there's, over the medium term, the Fed is likely to start pushing its R-star views even higher still. But for now, yeah, there is that.
So David, enjoyed this, sticking with July, with the idea that maybe they get pushed out to September and the election doesn't really matter. David Page, thank you, sir, of AXA Investment Managers. Conversation will continue the next hour of Bloomberg Surveillance with Sebastian Page of T. Rowe Price, the Ontario Finance Minister, the Admiral, James Stavridis, and Krishna Mamani of Lafayette College. All of that still to come. Equities right now on the S&P 500. If you are just joining us, welcome. Equities are doing okay. We're positive by 0.4%. Live from New York, this is Bloomberg.
This is still a Fed that wants to cut. The key question here is around inflation.
They are in a good place. They can hold rates, but if things deteriorate, they can also cut rates and have a substantial impact.
You could call it a sugar high coming from the easing in financial conditions. That's why supercore inflation is accelerating so quickly at the moment.
We are going to have higher inflation, we believe, for longer, and higher rates.
They need to get away from this excessive data dependence. They need to look forward, and they need to have a view.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The phrase of the morning, and good morning to you all. Pretty fully bully from Bank of America in their Global Fund Manager Survey. The most bullish fund manager survey, they say, since January of 2022. The biggest jump in a global growth optimism since May of 2020. And still bullish. Max Kettner, HSBC, with this a little bit early this morning. Bramo, we extend our stance in high yield credit to max bullish.
Basically saying beyond geopolitics, fundamentals have not changed. We see more tailwinds coming for growth in the coming months. Have not changed. The fundamentals. That is what a lot of people have said. Even if there is some turbulence in the market, they're still going to be investing. That said, at what point do the fundamentals change? If we don't get earnings that overwhelm, and if we do get a yield on the 2-year, on the 10-year, approaching 5% and beyond.
Well, let's go to the prices right now. We could talk about the yield just briefly on a 2-year and a 10-year. We did breach 5% again yesterday for the second time in about a week. At the moment, we're down 2 basis points on a session to 496.20. We've had a massive repricing of the front end of the curve. And this is the point I think that Max is making this morning, Lisa. The starting point is a much more hawkish one now than it was at the start of the year. And even only mild downside surprise in inflation and activity data should therefore reduce concerns about the Fed not cutting at all this year. I guess he's saying the balance of risks around this story have shifted quite markedly over the last few months.
At a certain point, you have to hear what he's saying, given the fact that at one point we were pricing in 7 rate cuts. Now we're pricing in fewer than 2. If you really do believe that this is a Federal Reserve that's going to cut rates, this is a market much more appropriately priced at worst, and at best is one that's priced much more hawkishly than what the Fed is actually going to deliver. And this is the thesis that a lot of people have who still believe that the Fed is going to get the ammunition that they have to cut rates before the end of this year.
Before the end of this year, but potentially not before the election. I was looking at, Jonathan, what Powell needs to see before November 5th. There's 4 Fed meetings, May, June, July, September, 7 jobs report, including the one just before the U.S. election, 6 CPI reports, and 7 PCE. You have to think at least half of those have to be almost priced for perfection for him to take that cut.
No doubt if Renmax still thinks the door is open for July. We just caught up with AXA Investment Managers. They still think the door is open for July. Let's talk about what President Biden wants to see. We know what he wants to see because today he's going to meet with some 200 steel workers. And guess what he wants to talk about? He's calling for higher tariffs on Chinese steel. Shock horror. We know that as the election campaign starts to pick up, as the year grows older, as we get closer and closer to November, you're going to see more calls like this. This is just the beginning. We're still waiting for a big call on Chinese EVs.
There's going to be a lot of policy levers they can pull before the election to try to tap into certain parts of the electorate. This was the quote that stood out to me when the Financial Times' write-up. It's important for us to get ahead of China's new export surge and their continued pressure on prices that make it hard for American steel companies to compete. Although when you look at what this would actually impact, it's not a ton of Chinese steel. Then the senior official went on to say, quote, nothing to do with elections. If that's the case, then why are you doing it now?
Okay, I don't think anyone reads that on its, say, first surface and says, okay, I guess it's not. You know, I mean, I think everybody understands this through a political lens. Let's be honest. From a market perspective, I do wonder, though, what do you do with this? Do you view this as sort of a sign of what's to come? Do you view this as a policy? Do you trade around it? Do you talk about the next step with respect to electric vehicles? How do you then figure what that's going to do to the complex in the United States? We talked to a number of executives in Detroit. They said it hasn't had a big impact on their auto sales, some of the Chinese competition yet. So these are the things that make it very difficult. What did Lori Calvasina said? I love this. Staring
at the sun.
Yeah, that's kind of how it feels.
Do you not trust politicians when they tell you it's not about politics? Do you not trust them? It's not about the election.
Look at that bond yield.
Look at those bond yields. Let's get to them right now. Equities at the moment, positive by 0.4%. We could talk about bonds as well. A 10-year getting very, very close to 470 in yesterday's session, then backing away. We're down another 2 basis points to 464.90. Coming up this hour, we'll catch up with Sebastian Page of T. Rowe Price on his aggressively neutral stance. We'll speak to Admiral James Stavridis as the United States weighs fresh sanctions on Iran, and Chris Mamani of Lafayette College on why it's still, for him, a T-bill and chill environment. We begin with our top story. Fed Chair Jay Powell putting rate cuts on the back burner. Sebastian Page of T. Rowe Price writing this: I'm very enthusiastically, with lots of conviction, aggressively neutral between stocks and bonds. What would it take to get us to overweight stocks? Most likely a market sell-off. Seb is with us here in New York. Seb, good morning to you.
Good morning.
I don't want to know why you're not enthusiastically bullish stocks. I want to know why you're not enthusiastically bullish bonds yet, given the repricing we've had in fixed income. Why not?
Well, first of all, as an asset allocator, we spend a lot of time on strategic asset allocation, which you never talk about on surveillance. But part of me being aggressively neutral is saying, believe in your strategic asset mix, all the work that advisors are doing with you. Why are we not more bullish on bonds? I think we will continue to see upward inflation pressure and potentially upward pressure on rates, specifically on the long end. So, Jonathan, we're long in the short end,
got it,
but still worried about the long end.
Do we not have strategic conversations on this program?
Strategic asset allocation.
Okay.
Well, actually, that's not true. We talk about what
the 60-40.
Well, right. Not just the 60-40.
We talk to him every month.
And we do. And also, what about gold
I'm questioning
and bonds?
that now.
All right, carry on.
Let's talk about the long end. What are you waiting for? 5%? Are we sitting here waiting for an extra 30 basis points to make this interesting?
Well, I think these moves do matter. And yes, we would change our view at 5%. And look, on the inflation side, just look at Q1 data. We're running at 5% annualized inflation. And this is not what the Fed expected. You know, economists will say, don't look at 1 month of data, don't look at 2 months of data. You know, I'm a runner. I like to look at my watch and see the pace at which I'm going. The pace right now for inflation is 5%. So to me, you know, I look at shipping costs. I look at wages, Atlanta numbers, Atlanta Fed, 4.7%. I look at unemployment, sub 4%. Oil prices, gasoline is up 18%. So I don't think we're out of the, out of the woods here with inflation pressures.
You look like an 8 mile per hour kind of pace. Is that correct?
No comment.
All right. Well, just talking about this idea, if you do believe that there is this inflationary pressure and it's going to reassert itself in the United States, why do you believe in a broadening out? Especially because we talk about the divergence between the U.S. and the rest of the world posing a real problem for their growth outlooks and their ability to cut rates materially because of the FX channel.
Yeah, I love that question because there's different ways of looking at the broadening. We're positioned long large cap value, but we're actually neutral now between large and small. Now, think back to 2021. How naive are we to think that bonds can only go down 2%? And think about everything that's happened since then. Imagine I show up with a crystal ball at the beginning of 22, say the end of 21, and I say, okay, we're going to have 550 basis points of hikes. We're going to have the number 2, number 3, number 4 largest bank failures in history. We're going to have wars in Europe and in the Middle East. And what would you think, what would you predict the S&P would do? Probably down. The S&P is up 11% since then. However, on the broadening, the average stock in the world, the MSCI All-Country World Index Equal Weighted, is down 13% since the end of 2021. So that includes more value stocks, emerging markets, small. Where we're making our bet on the broadening is value, which joins the inflation theme as well.
So we're now going to talk about strategic asset allocation here on Surveillance.
That's rare.
I think that it's something we never do, evidently. And I really think we should dig into it. In particular, how you're viewing sort of the idea of a hedge. And we've been talking about this extensively. You don't like bonds. You're worried about inflation. We saw the biggest surge in overweights with respect to commodities in the Bank of America Bully Fully survey. Are you on that same page, that this is a strategic way to sort of hedge inflation in a sort of longer period of time?
Yes, and we like real asset stocks because you get the expected return of stocks, but you're talking about metals and mining and commodities and energy stocks. And strategically, we have a 5% allocation dedicated to real asset stocks in our portfolio. Also, in a regime, in a strategic asset allocation question, in a long-term regime where you get more inflation volatility and maybe inflation stabilizes higher than expected, having a shorter duration position, and maybe, what you can do strategically, take your 40% bonds, shift 10% towards absolute return strategies, right? So that would be a strategic move to hedge against greater inflation volatility. Very popular nowadays, hedging your equity risk, downside protected equity strategies. These are all ways to modernize your 60-40, if you will. So I'm glad you asked about strategic asset allocation.
Where does gold fit in? Where does gold fit into that, if at all?
I think broadly within a diversified real asset equity portfolios. So in our portfolios, our clients don't expect us to trade commodities and have very long specific commodities positions. So broadly diversified in the metals and mining stocks is how we would think about it in terms of.
So then you have an exposure then to the international landscape. I'm thinking the United Kingdom, Australia. Is that where you like these assets?
Yeah, and we're close to neutral between international and the U.S. Those aren't the most exciting positions, but strategically you do want to be diversified internationally. Now, you don't say that lightly because that's pretty hard to do when the U.S. large cap stocks have dominated for 10, 15 years. So you really need to think about this hard. But it makes sense to have a broadly diversified portfolio.
When was the last time that you really recalibrated the strategy? And what would make you recalibrate it once more, given that right now the market seems to be recalibrating the paradigm that we're in every couple of months?
Yeah, so from a tactical perspective, at the end of October, we bought $3 billion worth of stocks. The market was down 10%. We like to lean in when the market is down. For us, that was a tactical recalibration. We review the strategic asset mix about every year, but I will say now, right now, everybody in the industry, I just spent a week in Asia talking to the world's largest investors. Actually, everybody wants to talk about strategic asset allocation. And now's the time to review what it means to do SAA in a higher rate environment, higher volatility environment. If you go back a very long time history, real rates have averaged 3%. The only exception was the new normal, if you will, the post-financial crisis, which was 0. So I wrote this paper, which is the new normal was abnormal. So the question of strategic asset allocation is on investors' minds right now.
Sebastian, we appreciate having that conversation. I think I prefer the other Page. David Page?
I like both of them.
Sebastian Page, a two-row price.
They grew up together.
So it's good to see you.
Thank you.
Appreciate it.
Not related.
Let's get you an update on stories elsewhere. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. President Biden is calling for new tariffs on Chinese steel and aluminum products ahead of a visit today to the Steel City. Biden set to visit steel workers in Pittsburgh as he ramps up efforts to shore up the American steel sector before November's election. The president will propose 25% tariffs on certain Chinese products as part of a wider review and will repeat that the company U.S. Steel should remain American-owned. Boeing's safety record will be under scrutiny today on Capitol Hill. The Senate is holding two separate hearings on a whistleblower's claims of poor assembly processes and shortcomings in the 787 Dreamliner program. Senators will hear from a Boeing engineer who worked on that plane for years, plus safety experts from NASA and the academic world. Boeing executives will not be there, but CEO Dave Calhoun is expected to testify at a later date. And Senator Bob Menendez is preparing to blame his wife at his bribery trial. Court documents show Menendez will claim his wife Nadine withheld information from him about gifts the couple allegedly accepted from businessmen and the Egyptian government in exchange for favors. Menendez's legal team is trying to get a judge to try him and his wife separately. That's your Bloomberg brief. John?
Yahara, thank you. What did you message me last night? Until politics do us part.
Yeah.
Is what you said.
It's basically, nothing says love like incrimination.
Brutal.
I find
Absolutely
this-
brutal.
It's a charming way of endearing yourself with someone after years of marriage.
Okay.
So they have the gold bars trial, and then I think it's probably headed to divorce trial.
Yeah,
right?
you think? Based on some of that.
Maybe this is what makes them tick, who knows?
I think we should say less about this if we can. Up next on the programme, a Wenger response to Iran.
I fully expect that we will take additional sanctions action against Iran in the coming days.
That conversation up next, live from New York this morning. Good morning.
So you are.
Stocks on the S&P 500 positive here by 0.4%. Yields a little bit lower, but down 2 basis points, 464.90. Things calmer. And maybe the epicenter of that calm is both the bond market and the FX market too. The dollar weaker, euro stronger, 106.46. Under surveillance this morning, Wenger response to Iran.
I fully expect that we will take additional sanctions action against Iran in the coming days. We don't preview our sanctions tools, but in discussions I've had, all options to disrupt terrorist financing of Iran continue to be on the table.
Here's the latest. The US set to impose fresh sanctions on Iran as Israel weighs its own response to the weekend's missile and drone attack. National Security Advisor Jake Sullivan saying the president is coordinating with allies on, quote, comprehensive response, adding we anticipate that our allies and partners will soon be following with their own sanctions. Admiral James Stavridis, the former NATO Supreme Allied Commander and co-author of 2054, a novel, joins us now. Admiral, wonderful to get your expertise on this programme once more. It's fantastic to catch up with you, sir. I want to start with this question, and it's what did we learn over the weekend? And by we, I mean Iran. What do you think Iran learned about the missile defense system in Israel?
They learned that it is formidable, that it is comprehensive geographically, and I think above all, Tehran would have been surprised at the extraordinary coalition operation. I've spent a lifetime in the military, a lot of it doing air defense, guided missile destroyer command, for example. The hardest thing in the world is to knit together the Israeli air defense, the American air defenses alongside Jordan, UK, France, and put them all together. I think Iran was unpleasantly surprised at the coalition level, the comprehensiveness, and most obviously, John, at the result, 99% batting rate, knocking down incoming missiles.
Do you think the success of that defense, Admiral, will shape or influence Israel's response?
No, I don't. As follows. The Israelis are clearly looking at it, and I think they should, as a massive attempt to bombard their homeland, something they have not done to Iran. Heretofore, it's been between proxies, fighting more or less. Now you've got the Iranian military, specifically Revolutionary Guards, and elements of the conventional Iranian military launching a massive wave of missiles at Israel. So they will respond. I think they'll respond in a measured way, but clearly they are going to take on this challenge from Iran.
Is there a way Israel could respond to make sure that there's deterrence when it comes to Iran, but not make sure that they're sparking off some revenge cycle in the Gulf?
Yeah, this is exactly the right question. It's the one clearly under discussion in the War Cabinet. And I'd think of it as an ascending ladder of violence, meaning option one, do nothing militarily, but impose sanctions, more diplomatic aggressiveness, try and get all your allies on board, perhaps some cyber response. I think option two is you go after kinetically, perhaps maritime assets, Iranian warships. You up the cyber game a bit. You certainly throughout this are going to go after the proxies. Option three is a strike on the Iranian homeland. That could be fairly tightly packaged, perhaps going after the industrial facility where the drones are built. Option 4, and let's hope the Israelis don't pick option 4, would be a massive counterattack, hundreds of missiles, both ballistic and cruise, aircraft, all of that thrown at major military targets across Iran. I don't see that latter option. I think you'll find a mix of option 2 and 3 as I just described them.
One of those options had to do with the Red Sea. And this morning we have new reporting that there's a naval mission underway with you have the Iranian Navy escorting some of their commercial vessels from the Gulf of Aden to the Suez Canal. Do you think Iran is preparing potentially for some sort of retaliation in these waters?
Clearly they are. And let's recall immediately before, perhaps a day before the strike against Israel over the weekend, the Iranian Navy, in what can only be described as an act of piracy, seized a large merchant ship that is ultimately owned by Israel, by an Israeli business concern. So Iran kicked off that cycle as well. I think the Israelis have to be contemplating something in retaliation for that, hence the escort by the Iranian warship.
Admiral, I've been trying to understand why Iran has felt so emboldened to take these new steps to directly attack Israel on its own land, to move out of the shadows. How much is Iran being emboldened by its relationships with Russia and with China?
Oh, you've put your finger on it. That's what's different. Over the last 3-4 years, particularly Russia, Iran is beginning to feel very comfortable in this partnership they have developed, which at its heart is transactions for weapons, with Iran providing very significant, fairly sophisticated drones to the Russians in their attack on Ukraine. This, in turn, feeds the Iranian sense of having, if you will, a larger coalition partner behind them. And then finally, with China, Iran is fully engaged in the Belt and Road Initiative, has received billions from the Chinese in investments, more of an economic relationship there, but both of those have emboldened Iran.
Admiral, given the fact that they have their own coalition or the appearance of one, how much do sanctions really work, to the extent that they've worked at all to this point?
I think sanctions are always an imperfect tool, and we can go back to the global sanctions imposed on South Africa during the apartheid era. It took decades for them to really create a sense of economic disadvantage, which caused a part of why South Africa changed course. So this is, anytime you impose sanctions, it's going to be take time. And here, you're absolutely correct. These are pretty leaky sanctions with at least a third of the world's GDP, maybe a bit more, simply not participating. Not only China and Russia here, but, for example, India not participating in the sanctions against Russia that were correctly imposed in the Ukraine war. So it will take time. It's better than nothing, but we should not believe that it will be the path to changing the course of Iranian bad behavior.
Admiral, you mentioned China. Can we finish on China? You're out with another book, the follow-up to 2034, again with the brilliant Elliot Ackerman, a good friend of this program as well, like you, Admiral. The 2034 book was a novel of the next World War, and I just want to talk about the situation between China and the United States. I don't know about you, Admiral, but waking up this morning and hearing the president talk about the prospect of upping tariffs on Chinese steel and referring directly to building ships in America, what do you think we're drifting towards here?
I think, unfortunately, we are drifting toward the possibility of more tension in the relationship. But I'll close my reappearance on surveillance on a mildly optimistic note. I think a good deal of what you're going to hear in that regard over the next coming months is, in fact, tied to the election cycle in the United States. Once we get through that, I think that there will be a possibility of the two sides finding their way to a better modus vivendi. There are clearly going to be no-go zones in the relationship over everything from Taiwan to South China Sea to military competition itself. But I think the possibility of continuing to have coupled economies and not stagger into a decoupling of these two massive economies, I think I'm cautiously optimistic we can work through that after the election.
I think we can all agree we hope your great novels remain just that, novels, fictions. Admiral, thank you, sir. Admiral James Stavridis there, former NATO Supreme Allied Commander. Bramo, certainly a big focal point going into November.
Especially because this has got legs on either side of the aisle, right? This is not something that's just going to live and die within just this election cycle. And it raises to the question, are we realizing we're in a new world where China wants to do one thing and we have to fight in a different way?
Trump or Biden, Chinese tariffs are on the way. Doesn't matter.
Big time. Coming up on this programme, Canada raising its capital gains tax in a bid to make housing more affordable. That conversation up next. We'll catch up with the Ontario Finance Minister. That's just around the corner. Things are doing okay, pretty steady here. We're positive by a third of 1% on the S&P 500. Steady yesterday as well, following the biggest two-day loss on the S&P 500 since spring of last year. Equity futures positive on the Nasdaq. We're up by a quarter of 1%, and the Russell attempting to bounce back by 0.6. If you switch at the board and get to the bond market, breaching 5% again yesterday on a two-year, but only briefly, back down to 496.85. We're down about 2 basis points. Lisa, back down to about 465.52, down a single basis point on a 10-year maturity. Sebastian Page of T. Rowe Price with us a little bit earlier this morning. Not ready to buy that just yet. He's waiting for 5%.
Or 5.5%, the potential for a much higher long end of the curve. And this really goes down to a question of, does this Federal Reserve allow inflation to run hot? What does that mean longer term? And what will it take to bring inflation back down if the Fed does cut rates? And even if they hold them here, I mean, there's so many questions that I have going into this. But what I'm watching, 20-year auction today, see if there's still the demand for U.S. bonds. Yeah.
It's an odd one, though, isn't it?
It's such a weird one.
20-year maturity.
Yeah, but
is it still that kink on the yield curve?
Yeah,
where the 20-year is?
Yeah, because basically it's less liquid, so you have higher yields on 20-year than 30-year. That's the kink.
Why should I care about that, Why should I care?
You're right. You're absolutely right. And then it's going to come in a weak auction and everyone's going to freak out and it's going to direct the rest of the move and the rest of the afternoon because this is the concern. It's just fueling that narrative of supply versus demand and the imbalance.
Well, the mood of the moment is okay. And maybe thanks to what's happening in foreign exchange, or rather what is not happening. We've had a lot of dollar strength recently. We've hit the highs of the year and we've backed away. The euro's a bit stronger on the session, the yen as well. Sterling too, cable at 124.58. But I think this is still a problem. 154 on dollar yen, Lisa. And you mentioned China as well for the Chinese currency. What do you do with this? The dollar just absolutely ripping over the last few months.
You could argue that maybe they want a weaker currency, but to what extent? On the other hand, how much does this tie the hands of the People's Bank of China to cut rates at a time where they want to juice growth much more than they're seeing currently?
The dollar's in the driving seat. Let's get to the top stories. Under surveillance this morning, Fed Chair Jay Powell pumping the brakes on rate cuts. Powell saying recent data indicates it will, quote, take longer than expected to achieve confidence that inflation is headed back to target. Annmarie, the emphasis of the last 24 hours, in fact, the last month or so, the emphasis is on time. The time it will take to get back to target.
Can't hurry rates because he doesn't see the confidence. The confidence isn't there in the data. And then you look at all the data that's coming out, because the reason why everyone cares so much about this year and the time is because there's a huge election in November. So they have 4 Fed meetings before that election, 7 jobs reports, 6 CPIs, and 7 PCEs. It's not a lot of time for them to see. It can't be just one print. It needs to be at least 3. And he pretty much tactically said yesterday and implied, yeah, it's not bumps, as we've all been talking about. This looks like a trend.
It's kind of funny to me that it's either July or December for so many people, with the exception of maybe David Page of AXA, who was with us this morning, who said September, and he thinks it can happen in September because he doesn't think the election matters that much. But for everyone else, if it doesn't happen in July, they believe the window's closed and you have to wait until after the election, and you can't go immediately after it. You've got to wait until December. Do you buy that? Does it matter that much?
It depends whether the data is sufficient to really justify it in the market's eyes. If you get sufficiently weak data, my God, I sound like someone who's speaking from the Fed hymnal. But if you get sufficiently weak data, you will end up having the justification to cut rates. If it's on the margins, on the edge, wait till December.
Do you speak like a Fed official at home?
I do.
Around the dinner table?
I say, this is sufficiently inappropriate behavior to please leave the table.
I bet the family loves that.
They love me.
Let's get to this story. I'm sure they do. United in the pre-market, positive by something like 5%. The airline reporting better than expected results this quarter and second quarter forecasts that beat estimates, easing concerns that aircraft delays from Boeing and regulatory pressure could put its expansion plans at risk. That stock is up right now, Annmarie, by 4.99%.
They're walking this line very carefully, and people were pretty surprised on how well they did, given the issues with Boeing. But I look at this and I say, ooh, they're not expanding as quickly as they want. Yeah, they're making some moves to their domestic capacity. But what does this mean for airline prices this summer? Because it feels like they're going to be going up, especially on top of that, not just Boeing on one end, but jet fuel prices are going up with oil and gas prices higher.
What would you prefer? Free internet, better snacks, but kind of, you know, an old plane to fly in?
I'll take a safe flight.
Well, no, I mean,
I'd
safe but old.
a plane without the ashtrays in it.
Okay,
you know, like one of those.
We're not flying
Stop
Connie.
flying Air Italia.
You know, the planes from 30 years ago.
Okay, I'm just saying, because they're going to probably be older planes, but then we just heard from Sheila that they're going to just offer some more amenities. I don't mind.
Well, they're going to give you better food and free Wi-Fi.
Yeah.
So long as you fly the plane with the ashtray in from 30 years
We're
ago.
not flying Connie. You should go to the TWA
All right.
museum.
You
It's
let
really
me know
cool.
who you fly with today. And let me know if it's got ashtrays in the front. All right.
carry
Let's turn to the news out of Canada. Raising its capital gains tax on businesses and wealthy individuals as part of a bid to make housing more affordable. The announcement coming amid poll data showing Prime Minister Justin Trudeau losing support among young voters over housing prices, which have jumped around 60% in Canada since he took office. Joining us now, I'm very pleased to say, Ontario Finance Minister Peter Bethlenfalvy. Minister, fantastic to catch up with you, sir. Thanks for being with us.
It's a pleasure to be back in New York.
What did you make of that tax change, that announcement, just yesterday evening?
Well, as a conservative provincial government, I never believe that taxing your way to prosperity is the way to go. So, and they did nothing on the carbon tax. We have a carbon federal tax in the province of Ontario. We cut the gas tax, so we're going one way, they're going the other. But I just don't think you can tax your way to prosperity.
Is this going to hold back investment, do you think?
I don't think so. Ontario's 40% of the Canadian economy, and we're booming. We've got, over the last 2 years, 1 million person population growth, growing faster than Florida or Texas. People are coming to Ontario. So we're rebuilding the economy. We've got capital flowing in. We've had $28 billion of capital investment in the electric vehicle production, supply chain, and assembly. We've got growth in many parts of the economy, advanced manufacturing, and we're building, everything like highways, subways. We've got more subways, more cranes going on in Ontario. So it's a real opportunity to build the economy.
How much does particularly the capital gains tax hike lead to actually more unaffordable homes, just because people aren't going to be selling them if they're going to be taxed to such a high degree?
Well, this is, to be clear, this is not on your primary residence. So in Canada, your primary residence is exempt from capital gains. So it's not really going to affect the residential home market. Look, we've got a robust plan, and I will give the federal government some credit that they're investing in the infrastructure to build more homes. So water and sewage, not the most exciting thing, but it's the plumbing that you need to build more homes. We've got an ambitious target in Ontario to build 1.5 million homes, and we're going to do everything to get there.
How do you get the confidence from investors to actually have the capital to do that at a time where growth is weakening? There's a real question about the sort of debt overhang. We're dealing with that in the United States. And the whole idea of how you're going to raise that revenue could curtail growth, which makes it even less attractive. How difficult is it?
Well, again, we're in Ontario, which I'm the Minister of Finance, we're 40% of the country. So as Ontario goes, Canada goes. And as I mentioned, we've got the population growth. We just issued a 10-year U.S. bond yesterday. It was very well received, and we had more investors for a U.S. 10-year deal out of Europe, Asia, and the Middle East than we had in the U.S. So we're getting broad demand. And so I think that we're just going to continue building the infrastructure, rebuilding that economy. And the other thing that we're doing with that population growth, we put a lot of money into reskilling and retraining the workers, and particularly in the skilled trades, because you need people who actually know how to build the hospitals, the highways, the subways.
You want that population growth. That's what's interesting, Keir. When I talk to you, when I hear you speak, you are fiscally somewhat conservative. But when it comes to immigration, you have a very different view than maybe some Republicans might have in this country. Your population in your province has gone up to 16 million. This is by design. It's what you want to see as well. What is that turning out to be like? How is that working out? Are you able to build housing quickly enough to accommodate the people that are coming into your area?
It's a good question, and yeah, it's not. We can't have immigration and not have the infrastructure in place: the schools, the hospitals, the highways, the subways, the transit to move people. So it's a balance. I'm the son of Hungarian refugees from World War II, and other than Indigenous, everyone in Canada came from somewhere else. So it's been the Ontario dream, the Canadian dream. We've been a beacon of stability and hope for many people around the world. So we welcome that. But we have an obligation in Canada to make sure that we can accommodate that growth. And I think that's what you're talking about. And we've got a plan in Ontario to do that.
A lot of analysts I talk to say the United States trains high-skilled workers and Canada steals them. Is that actually what you see going on?
We're pretty shameless in Canada. We accept people from all over the world. And my wife is American, born here in New York. That's the tradition and history of Canada, that we're welcoming of people around the world. They just want to, when they come to Canada, they want to have a good job, they want to feel safe, they want to be able to raise a family. So that's why our government is very focused on making sure that we combat crime, we have the infrastructure, we rebuild the economy, and we train the workers for the jobs of tomorrow.
This feels like a big investment phase for you, and not just you, but also at the federal government level as well. How do you balance the budget with that in mind?
Yeah. So in Ontario, I'm the only major jurisdiction in Canada to have a path to balance. We balance at the end of in about 3 years. So we have a path to balance. Yesterday, the federal government, they did not have a path to balance over the 5-year period. We're committed as Conservatives in Ontario to we think we can do both. We think you can have a healthy economy and a healthy balance sheet. You can do both. And that means that we're not passing on a lower standard of living to the next generation, or that they have to raise taxes or cut spending.
How do you then adjust expectations when it comes to benefits that people receive from the government? This is a question that the United States is facing in a significant way, given the deficit here. Do you have to cut back in certain areas in order to provide that stability for future generations?
No, we don't. We do index some of the support payments, like our Ontario Disability Support Program, low-income seniors, we index it to inflation. But we've chosen a different path to be able to afford all those payments and all the infrastructure that we're building by growing the economy. So we just believe in economic prosperity and putting in place the conditions to be able to let people and families and businesses grow.
Yesterday, we had Jay Powell sitting next to the Bank of Canada governor, and they were talking about the export back and forth and the friendly relations between these two countries. But this administration, with the Inflation Reduction Act, many in Canada lobbied before it came out, saying this was protectionist to the United States. How is this? Where do you see this going now? Have they assuaged the concerns that the Canadian government had before this came out?
Yeah, there were some concerns for sure. Buy only American. And we said, hey, look, we've been a trading partner for a couple of 100 years and on good terms. We're your friend. We're your ally. Work with us. So we found some common ground. And to their credit, the administration excluded Canada from that provision. The Inflation Reduction Act, we responded. We'd prefer not to see protectionist type measures. We're a free trading country. We championed free trade in 1988 with Prime Minister Mulroney, who sadly recently passed away. But we continue to believe in free trade. And the United States is our best friend and ally on the planet. So we'll continue to find ways, as we have for the last couple of 100 years, to do deals.
It's ideal to find someone else that believes in free trade. Can you find them right now? Do they exist? Who are they?
Well, we're a small, open economy, so we do continue to trade. We have a trade deal with Europe. We have a trade deal, obviously, with the U.S. We do a lot with Asia. As I just mentioned, our bond issuance was...
Oh, without a doubt. The reason I asked the question, Minister, as you know, it's all well and good you believing in free trade. I do as well. But the problem is there are leeches on the free trade system, and one of them has been China, which is why we're in this position anyway. And what we're seeing now is the rise of industrial policy in America because of what's happened in China, because China's been very successful developing industry doing just that. We're going to see it in Europe too. How does Canada compete in a world where everyone seems to be drifting towards really big subsidies and manufacturing that is local and not international?
That's a very fair point. We just continue to find ways, like in advanced manufacturing, life sciences, technologies, to set the conditions within. Government doesn't create those jobs. The private sector does. So our view is, as Prime Minister Harold Macmillan said many years ago, the toughest thing in government is events, dear boy, events. So we deal with events, and we're very nimble in Canada. We're a trading country. And so we know that we'll be able to come out the other side through the economic cycles.
Minister, we appreciate your time. Thank you, sir. Enjoy New York.
Thank you. It's
good
pleasure
to see
to be with you.
Peter Bethlenfalvy there, the Ontario Finance Minister. Let's give an update on stories elsewhere. We can do that with your Bloomberg Brief. Let's cross over to Yahara Hakez. Hey, Yahara.
Hi, John. The SEC is cracking down on the use of third-party messaging apps on employee phones. The agency is now restricting access to platforms like WhatsApp, plus SMS and iMessage. The restrictions are meant to help improve record keeping and address potential security vulnerabilities. The SEC's Twitter account was hacked earlier this year through a staffer's agency-issued phone, which resulted in a fake post announcing the approval of spot Bitcoin ETFs. Tesla will ask shareholders to vote again on its compensation package for Elon Musk. This after a court in Delaware voided the $56 billion payout arranged for the company's CEO back in 2018. In a proxy filing, Tesla also said it will call for a shareholder vote on moving the company's state of incorporation from Delaware to Texas. And record rainfall in Dubai led to flights being diverted and cars being left stranded on flooded roads. It's the heaviest downpour in the United Arab Emirates since 1949. That's according to Dubai's media office. It comes after the UAE has been carrying out cloud seeding, an operation involving spraying chemicals into the atmosphere to squeeze out more rain from clouds. It's done that 7 times this year as it aims to address water security issues. I learned something new. That's your Bloomberg Brief. John?
Yeah, Harry, thank you. They got the rain they engineered, right? This is what they wanted, and they didn't develop the drainage. This is like, infrastructure. First.
Right. Well, they've been doing it since, 2002? I mean, they've been doing it for a very long time, and this has been a complaint. I don't think that anyone was expecting a deluge.
It's just always what the government does, though, right? They're doing it with EVs right now. Buy EVs, and then we'll do the charging stations.
I feel a bit...
Infrastructure first.
I feel a bit like Glass House, because, in this country we have...
I'm not sure, without a doubt. There are plenty of issues.
I mean, really, look around the world. Who does it the best?
Home country too. Problems all over the place.
They do it really well.
The Swiss probably do it the best.
Their infrastructure just...
Up next on the programme, putting rate cuts on ice.
If inflation gets much worse, they could hike. I think the likelihood of them hiking is low. Is it zero? No, they could.
What was I thinking? Canada, of course.
Go to Canada.
Forgive me. From New York City, this is Bloomberg. Equities on the S&P positive here by 0.33% on the S&P 500. Bond yields settling down. We're down a single basis point, 465.52. Under surveillance this morning, putting rate cuts on ice.
If inflation gets much worse, they could hike. But I think if they do hike, we're going to have a regional banking crisis. We're going to have all sorts of damage in the marketplace. And I think that is at the back of their head. So I think the likelihood of them hiking is low. Is it zero? No, they could.
Here's the latest. Yields hitting year-to-date highs, with the 2-year briefly touching 5%, as Fed Chair Jay Powell signals a delay in rate cuts. Krishna Mamani of Lafayette College writing, quote, "We remain in a range-bound market at best, with it getting buffeted by geopolitics, the Fed and data. While the economy is doing well, it is probably still a T-bill and chill environment." Krishna is with us around the table. Krishna, good morning.
Good morning.
I am surprised, sir, that we haven't had people come on this programme, banging this table, saying buy bonds. Why not?
Well, so buying bonds and buying T-bills is two separate things. So I think the rally that we had in bonds beginning November had to be unwound if the economic data was going to be as strong as it is. And that is what is taking place. I think 10 years today are much better value than they were before, but they can still steepen a little bit more. But T-bills, on the other hand, provide you a really good, or 2-year for that matter, provides you really good return in an environment where things are not moving in one direction in a big way, either in bonds or stocks.
Well, let's go to the opportunity and the balance of risks around the 10-year right now. The 10-year sitting, let's call it 470, so 465. What's the risk? We go another 50 basis points higher or 100 basis points lower from here?
Yeah, I think probably 5% is probably the upper end, and that basically requires the Fed not to do anything for an extended period. But if we have a significant slowdown, we are going down 100 basis points and in a hurry. And that probably creates all sorts of situations that increases demands for long duration in a big way. I think that's the kind of the convexity of bonds at the moment.
I understand the T-bill side.
Yep.
I don't understand the chill side, in part because at a certain point...
Because you have no chill?
Well, no, I have no chill.
I think that's a you problem, Lisa.
Hold on a second. There's a question, though, about going forward. If you really believe T-bills are the best bet, that implies weakness down the line. That implies something that is less than chill.
Well, no, not really. Well, what that is saying is that the upside in stocks is very limited in the current environment. So you need two things to work out. One, earnings to continue to grow, and for rates to kind of either stabilize or come down. One leg is, I think, working. It remains to be seen how long it'll work. So the point is, given where the market is relative to earnings outlook, the upside is very modest and the downside is significant if we have a 100 basis point cut in rates in a hurry, because we are now talking about a recession as opposed to a soft landing that we had been talking about for a long time. So it's a kind of a placeholder more than anything else. At 5%, or 5 and change, it's a pretty good placeholder.
So you're still in placeholder mode. That's what I find
Yes.
interesting.
Yes.
What are you waiting for to get some conviction?
Well, so I think what we are waiting for is really confirmation that the economy can continue to grow, and in an environment where the inflation continues to trend down. What we haven't seen in this year so far is inflation continuing to trend down. I think that's what we are waiting for, that data to come about, because the longer the Fed holds at 5 and change for, let's say, till the end of the year, the risk in the equity market is actually increasing rather than going down. So that's what we have to be mindful of in the current environment.
Given Jay Powell's comments yesterday, do you think they hold till the end of the year?
Well, I think a month and a half ago, he was talking about cutting in June. So I think they are as data dependent as the rest of the market is. And if things slow down, they probably bring it forward rather than later. But the challenge for the economy and the markets is there's really no significant sign of any slowdown in the economy. And until that comes about, everything is speculation, whether it's Jay Powell or us.
The emphasis seems to be on time, wait, and keep rates at current levels. They keep saying this, at current levels. Do you think we are sufficiently restrictive? Or are they just waiting for inflation to come down a little bit more and then real rates sort of narrow the gap and then they are restrictive and where they want to be?
Well, I think, for you to truly claim whether we are restrictive or not, you have to have a handle on where our star is, and none of us do. So let's admit that up front. Having said that, I think the true sign of tightness is, did the market rally when they were going to cut rates, and did the market sell off when they said they are not going to cut rates? And that sort of tells you as to how we are interpreting the current situation.
If someone were to come to you and say, I get T-bill and chill, but what about T-bill, chill, and gold?
Well, I have always had a tough time with gold for non-yielding assets. So, it's very hard. It's like Bitcoin for me. It's very hard to wrap my head around something like that. When you earn 5%, that's 5% of appreciation that you have to deliver from a competing product.
At least they're struggling to keep it together. So let's build on the gold story a little bit more. What do you think is driving things at the moment? What is behind that breakup? It's really, really odd to see gold rip, the dollar stronger, and yields climb. What is going on there?
Well, so, the dollar stronger part is easy. The rates are going to remain a lot higher. So that part, the check. The gold part is we can make any story we want. That's what the problem is. So China is buying. People in China are buying. It's kind of a replacement for yuan in some way. Or people in India all of a sudden started buying jewelry. I have no idea. The point is, it's a speculative rally, and it'll probably continue as long as the market uncertainty continues. If the direction of rates becomes a lot clearer, I'm not so sure gold would be doing as well as it is right now.
There's plenty of arguments for why gold is up here. Totally with you. We all agree. There are some people, though, there is one argument that is suggesting that it's very difficult to understand where I can go to find risk mitigation characteristics if we have some problems, and that problem might be higher inflation. Lisa's been asking about whether treasuries fulfill that role anymore. Does gold fulfill that role?
Well, I think if you think the gold fulfills that role, you have to believe that other places like China, which hadn't been buying gold in a big way over the, let's say, last 20, 30 years, all of a sudden are going to stockpile that. And that may indeed be the case. I don't know. I don't have that information. But it has to be some additional buying. The non-yielding characteristics of gold hasn't really changed. That is perennial. So in that sort of a context, you basically have to believe one of these stories with very sparse data, and I just can't get myself there.
You and I have talked for a long, long time, and I often ask you, biggest risk, upside risk or downside risk? And for a while in equities, you'd been saying upside risk. What about now?
Well, so the reason for T-bill and chill is the market environment is extraordinarily uncertain. And I think the upside in equities from current valuation levels is modest at best. And for that, a whole lot of things have to fall in place. So I think the upside is relatively modest, but doesn't mean the economy is not doing well and we are going to have a 20% correction. So from an optionality standpoint, it's worth owning. Having said that, having a full allocation or a significantly higher allocations in equities because of the perceived upside, I think is a tough case to make right now.
Krishna, you're brilliant, and this was awesome. Thank you, sir. T-bills and chill. Krishna Mamani of Lafayette College. Not much chill around this table.
Oh, look,
just a little bit of chill.
First of all, I think it's a fascinating idea. I actually think it's really smart because it's basically everyone comes on and says that they have no conviction. So where do you wait? And the idea is the idea of waiting and truly deciding to wait in an asset class that delivers some returns. It's an interesting concept.
Good. Coming up on the programme, Alicia Levine of BNY Mellon. We'll catch up with Akash Doshi of Citi, Diana Peterson of the Conference Board, and Bloomberg's Mario Parker. The third hour of Bloomberg Surveillance up next.
The U.S. is leading. And this is one reason we remain overweight U.S. stocks.
The U.S. dominates in relative space. It dominates almost regardless of what the global scenario is.
I think that we are in the midst of a game changer on technology.
The bar for earnings to surprise to the upside has risen.
For now, the economy is certainly riding the wave of the increase in the stock market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance begins right now. Your equity market on the S&P 500 positive by 1/3%, looking to bounce just a little bit here on the S&P 500. For me, always fascinated with the psychology of markets, particularly in fixed income. Let's get up the fixed income board and talk about this. What is it about bonds? You get a 50 basis point move higher, no one wants them. You get a 50 basis point move lower, everyone can't get enough. Bramo, momentum trading in fixed income.
And it's been, frankly, the momentum trade everywhere, but fixed income in particular. It seems as though this market is as whipsawy as some of the Fed speak has been, that basically you have data dependency in markets, you've got data dependencies at the Fed. And so basically every data point is cause for another 20 basis point move in bonds. And that's essentially what you're seeing. And it's hard to get ahead of that and move the other direction because we've seen this overshoot time and time again.
We've had tons of Fed speak over the last 24 hours, including the chairman of the Federal Reserve. But we also heard from the vice chair too. And I keep going back to this quote from the vice chair because I think it's the most important quote we've heard in the last 24 hours. If you thought there was a threat of higher interest rates, take a listen to this line. My baseline outlook continues to be that inflation will decline further with the policy rate held steady at its current level. They're just going to wait, Lisa, and wait a little bit longer and wait a little bit more.
You know, Powell even basically indicated that they're not going to hike rates also. He said, on the other hand, this inflation isn't a standard case of overheated demand. This is an issue with something else. This doesn't indicate that they need to kill it off like some sort of inflationary beast of the 1970s. And this is the reason why people are saying the upside risk to inflation is not necessarily in the same way baked into the markets, or should it be?
And Powell's saying recent data has not given us greater confidence, so they need more data, which I think without saying it, Lisa, you've brought this up, these are no longer bumps. This is now becoming a trend. And that timeline issue is going to be incredibly important.
The emphasis has changed, and we've talked about this a million times on this programme. In August of 2022, where Chairman Powell was at Jackson Hole and he delivered that 8-minute speech about pain, the emphasis was on pain. Now the emphasis, a few years later, is on time. Now, what you've got to work out as an investor, are yields up here, are they not cutting for the right reasons? Because growth is good, and that's coming with some kind of inflationary impulse. Is growth good enough? Will earnings be supportive of some of the valuations that we've got to over the last few months?
It's an uncomfortable time. And honestly, the sort of delinquency data that we keep seeing on credit cards and auto loans give pause. The idea that you are seeing small businesses struggle with higher benchmark rates. There are some reasons you could see this economy slowing more materially, which is the reason why there's a little pain. It just isn't widespread enough to get into the average numbers. And that's the reason why some people think maybe this is a real weakness.
Which is why after Powell spoke, I looked up Senator Elizabeth Warren's website, her tweets, have yet to see anything yet. But you can imagine if he's talking about this is going to be a lot longer, and everyone's talking about potentially now it has to be after November, there's going to be a consensus in Washington on the Democratic side of the party that's going to say, well, we've been asking you since January to bring rates down. It's hurting some people in the electorate.
Yeah, I'm not sure that's how it works. Just because the Democrats asked, the Federal Reserve has to deliver. But I imagine we might get a few more letters going into November.
Yeah, which is the reason why they're not going to cut rates in September. This is at least according to a lot of people in the market.
And that's the problem for many people. September. Why it can't be September? Why can't it be September? I don't get it. If the data's there, just cut in September.
And also, arguably, Powell did the best thing he could do for Biden when he just said there's going to be a pivot. And then we've seen this bull market rally. That is when he helped help the electorate in terms of how they view the economy and Biden. I don't think, given the lag effects of monetary policy, September is going to matter to November.
The reason why I was laughing so hard at T-bill and chill is because telling Wall Street to chill is ridiculous. There are all these really intelligent people who are paid to analyze and get ahead of the markets, and there's no way to get an edge on this. So there are people coming up with every narrative under the sun when really they have to be chilling and watching the data. It's a very difficult nut to crack. I understand that personally, but this is basically what we keep seeing.
You're super chill. Equity futures right now on the S&P, positive by 0.25% in the bond market anytime. Yields are lower by a single basis point, 465.52 on a 10-year. The dollar's weaker today against the bulk of G10, the euro firmer, 106.40. Coming up this hour, BNY's Alicia Levine on why markets can still reach new highs. Citi's Akash Doshi looking for gold to hit 3K. And Dana Peterson of the Conference Board on C-suite optimism. We begin with our top story. Fed Chair Jay Powell signals another delay in cuts. BNY's Alicia Levine saying this: the market is more aligned with the Fed than 3 months ago. That move from 6 to 3 hikes happened with barely a hiccup in the equity market. We think the Fed will cut less and later. It could be 2. As long as the economy is strong and the labour market is resilient, the equity market can handle less and later. Alicia joins us now for more. Alicia, good to see you.
Good morning.
It's been too long. Let's talk about how you framed the year. We're talking about a year of 2 halves. I think the second half was going to be a little bit better maybe than the first half. How's that shaping up now?
So it looks like the first half was very, very strong, obviously coming into the first quarter up 10% on the S&P, up 11%, including dividends. Look, we're clearly walking into a counter story here in the last few weeks. So it's not just that the rate cuts are less and later, but it's also, is inflation higher? And then Powell yesterday just sort of said the part that we were all thinking, which is, are there no cuts at all this year? But to your conversation earlier, I think the issue is the pivot already happened. The pivot happened in December. To pivot from the pivot is going to be a very difficult thing for the institution. So we're in a place where, the Fed can hold this high for longer, but I don't think we go higher, right? So we're not pivoting from the pivot. And ultimately, the data really are hanging in there. I mean, the job market data has actually been extraordinary. And if you just look at a rolling 3-month average, 6 months ago, that rolling 3-month average of job creation was 220,000 jobs per month. We're now at 275,000 jobs per month. So we've ticked right back up in what is supposed to be a slowdown this year. And we've done it with wages quietly ticking lower. So there's a supply story going on in the labor market that I think the Fed is hanging their hat on here to kind of quietly bring inflation down on the labor side, on the wage side, even as we see some higher numbers in the services.
I remember you called 2021 the COVID excess years, 22, 23 were the transition years, and you were setting up 2024 to be the new normal?
The new normal. The
new normal. Do you think we're still in the transition years, or is this really the new normal?
So this feels like the new normal, which is we seem to have better labor supply. We have an economy that can grow at 2.5%. And we have inflation that's probably not going down to 2% anytime soon because we have some deglobalization, we have reshoring, and of course, we've got hot conflicts in 2 parts of the world where commodities matter, food and energy. So we're in a place of, let's call it 2.5% to 3% inflation as a steady state. That feels about right. We're also in a place where growth is likely to be higher than that 2%. Which we had in the post-global financial crisis world. So I think this is the new normal. This seemed like it would be the new normal. We've had hiccups along the way, but this doesn't feel problematic, right? We've lived in this world of 2.5% growth and 2.5% to 3% inflation quite well with 5% yields.
It's not problematic for Google. It's not problematic for Microsoft. It's really problematic for a lot of smaller companies that are struggling with highly leveraged balance sheets. At what point does that become a problem for the broader market, given that that's sort of the steady drum that hasn't gone away in the backdrop?
Right. So that's true. There has been a bifurcation here, and it's like the slow wringing out of excesses and leverage in all these challenged balance sheets. So you see it in the Russell, for instance. Russell's down 3% this year. There was a lot of hope last year with the pivot that this asset class would finally rally, still 25% below the highs of 2021. It is happening across the economy to smaller businesses, but the larger cap companies and the larger companies in the U.S. termed out their debt, meaning just like households, which termed out their debt at 3% mortgages, fixed rates. Large companies, sold bonds in 2020 and 2021 at 3 and 4% interest rates, and those are not due. The bulk of the S&P, that debt is not due until 2030 or later. So you have stronger companies, larger companies actually paying out debt at 3 and 4% and getting 5.5% on their cash, similar to what households are doing as well, just keeping that part of the market really solid. So the structure of the U.S. markets are going to protect the S&P from what we're seeing in some of those smaller companies. And yes, if the Fed keeps high for longer, then we will see that slowly wind its way through the economy. It's just really slow. And it's very unequal in how the higher rates and the contraction of credit is hitting the economy.
So what I'm hearing from you is own U.S. big tech companies and chill. Is there some room for, say, T-bills or, international or gold? Or do you just basically say you can have your general allocation, overweight U.S. stocks, just keep there, in particular, the tech names?
So we allocate to all asset classes. On the equity side, we have favored U.S. and large for several years now because it seems very clear that potential growth in the U.S. is just higher than elsewhere. And even though we get better than expected numbers from Europe or even China, it's just not enough to really go where the U.S. can go in terms of sustaining growth. I mean, you're looking at policies that have to, boost growth there. So we've been U.S. large cap overweight for a while now. We're very comfortable with that, but we do allocate everywhere. In terms of the bond side, we've always said you've got to, actively manage your bonds. We never said go long duration. We said, please get out of cash because we think it's a year where cash can underperform. We think as rates move higher, it is a great time. As you said, why does everybody want to go into bonds when rates come down 50 basis points? Like maybe this is the time to start walking out a little bit, but you have to actively manage it. And we still like alternatives here for that world where there are distressed assets to invest in and private equity valuations are steadily coming down. And this is the time you want to start getting into those vintages.
And what about gold?
So I heard your gold conversation earlier. Look, gold can be a risk-off asset or a risk-on asset. It is not in our allocations. It has no yield. It has no dividend. Just very hard to track here. But I think here gold is as acting as a inflation, an expression of discomfort with possible inflation bumps.
Okay, well, there's a lot of discomfort. We're at all-time highs. Alicia Levine of BNY Mellon. Alicia, don't leave it so long next time. It's good to see you.
I would promise to be back.
Thank you very much. Appreciate it. Equities right now on the S&P positive by 0.2%. Let's get to your Bloomberg brief. We can do that with Yahira Hackers. Hey, Yahira.
Hi, John. The U.S. is set to place new sanctions on Iran after the country's unprecedented attack on Israel. National Security Advisor Jake Sullivan saying new measures will target Iran's drone and missile programs. And on Capitol Hill, lawmakers are debating legislation to place sanctions on importers of Iranian oil. U.S. home loan rates are climbing once again. According to the Mortgage Bankers Association, the contract rate on a 30-year fixed mortgage hit a 4-month high of 7.13%. Despite higher rates, the same report shows home sales actually increased 5%. That's the first gain in 5 weeks. Mortgage rates are at risk of rising further, with the 10-year Treasury yield now at its highest since November. And the SEC is cracking down on the use of third-party messaging apps on employee mobile phones. The agency is now restricting access to platforms like WhatsApp, plus SMS and iMessage. The restrictions are meant to help improve record-keeping and address potential security vulnerabilities. The SEC's Twitter account was hacked earlier this year through a staffer's agency-issued phone, which resulted in a fake post announcing the approval of spot Bitcoin ETFs. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the program, it's gold's shining moment.
Gold is a marvelous sweet spot. It's a very good diversifier and a very good hedge for paper assets. That started a lot of buying coming in the last couple of months and sent this market to all-time highs.
At all-time highs and why it could go higher. Citi looking for 3K. That conversation up next. Equities right now on the S&P 500 positive by 1/3%. Yields are lower by a single basis point. Things are doing better. We're back to about 465.10. In the FX market, dollar's weaker, maybe steadying things. The epicenter of that calmness is coming from foreign exchange. The euro's a little bit stronger, 106.37 on euro dollar. Under surveillance this morning, it's gold's shining moment.
Gold is a marvelous sweet spot. You can be out of the dollar without actually being in another currency. Gold has proven to be a good asset to own during periods of elevated geopolitical risk. It makes it likely that not only would a central bank buy, but others would buy as well. It's a very good diversifier and a very good hedge for paper assets. That started a lot of buying coming in the last couple of months and sent this market to all-time highs.
It's the latest. Gold hovering near record highs, up just over 15% year to date. Citi's Akash Doshi writing this. We project 3,000 an ounce over the next 6 to 18 months. The recent gold rally has been aided by geopolitical heat and is coinciding with record equity index levels. So a steeper risk-off environment should further boost prices. Akash is with us now for more. Akash, good morning to you. I want to talk about the drivers here, if we can start with that. Can you help me understand? Because typically we'd associate a gold move with a weaker dollar and lower yields. This is happening the other way around. Why is that?
That's absolutely right, John. If you look at the gold rally over the last couple of months, it's coincided with a stronger greenback, as well as a real backup in nominal yields, as well as treasury yields, interest rate adjusted treasury yields. So I think a big part of it is financial flows are finally catching up to what's been strong physical demand, right? If you look at what's driving gold over the last couple of years, if I was sitting in the studio, Fed was at the zero lower bound. They were going to increase rates to 5.25%. No one would have thought gold would have averaged $1,800 to $1,900 an ounce, and then here at records at $2,400 an ounce. And I think the big driver is the official sector demand. It's been bar and coin demand from retail, very strong Chinese non-monetary imports. And I think that physical demand for alternative fiat, for reserve diversification in the official sector case, I think that's driving this gold demand on the physical side, and financial flows are only catching up.
That's interesting. Given the character of demand then, do you think there is no limit to the divergence we're seeing between, say, treasuries and gold at the moment?
I mean, the relationship is still there, but what we wrote in that note and what I wrote is that the duration has just shortened. So we think getting to $3,000 an ounce over the next 12 months is plausible if the Fed proceeds with, for example, insurance cuts, and nominal rates can still stay high, but then real yields would rally. If you have a turn in the dollar cycle, that would just be a kicker for gold getting even higher as financial investment flows come back into play. Also, given equities are at all-time records, were in the past week or two, you also have potentially gold serving as a macro overlay hedge. So if you do get an equity correction or unwind, if the market is mispricing U.S. recession risk, then I definitely think gold is a good portfolio diversifier there.
Recently, in the past couple of weeks, we've seen a repricing in the bond market about the idea of higher for longer. And what we hear from institutional investors and even some executives is that it's a pet rock and that it doesn't give you anything and that there's no runoff, there's no yield. And if you go into T-bills, you could get 5% and you actually earn something. How much are you seeing institutions pull back as everybody else gets in?
Well, I think the inflows are coming not only just from retail, but it is coming from institution. And if you think about gold, yes, it is a non-interest-bearing asset. So the move in rates is not a positive tailwind. But what we're seeing is it's not a negative headwind right now either. And I think it's for other reasons. For example, the central banks are buying gold not for yielding, but because it's a bearer asset. So you don't have credit risks. It's an alternative fiat. So some of the moves that you've seen in crypto this year, part of it on ETF launches, some of that overcapacity is clearly shifting over to gold and silver markets. I think also from the point of view is, can you monetize gold? You actually can in the options market. You can hold gold and sell and overwrite volatility on that. And in fact, a lot of private bank, ultra high net worth individuals that own physical gold, they sell options in the market and they monetize the volatility skew.
Well, so this is actually exactly what I was going to ask, and forgive me for getting very basic, but I do wonder about central bank buying of gold. Do they just sort of store it there? Are they looking to monetize it through options? Do they have a gold carrier who they can call 1-800 monetize my gold, and they can go and deal with it? I mean, what's the functionality of gold in a central bank portfolio?
Central banks are buying gold, which is physical gold that's typically stored underneath the New York Federal Reserve in London vaults. Some might be stored onshore, and some might be stored in France, Switzerland vaults as well. It is physical demand. It's used as a reserve diversifier. It's used as part of a broader de-dollarization theme, and it's dollar recycling, right? So as Treasury holdings might go down incrementally, gold holdings go up. But guess what's a smaller market? Fiat market or the gold market? The gold market is much smaller. So even incremental demand pull from the official sector, which is now 25 to 27% of annual gold mine production, that is a big boost for prices in our view. And we think that set a higher price floor. So as $1,000 became kind of the new price floor post-financial crisis, I'm arguing that 1,900, even 2,000 could become the new base floor for gold going forward, and that we're in a higher for longer regime, kind of resetting price expectations over a structural period.
How much do you think U.S. sanctions are driving that appeal to gold?
I think U.S. sanctions policy has been a big driver. If I look at central bank demand trends, they started increasing post-financial crisis after being net sellers for 4 decades. In 2014, with the Russian annexation of Crimea, central bank holdings started to increase further. Then in 2018, with the U.S.-Sino trade spat, they started increasing further again. And then most recently, over the last 3 years, you've had record central bank purchases since the Russia-Ukraine war.
But these purchases, you say, are stored in places like downtown at the New York Fed or London. Is there a point where, if they're owned by that central bank, the U.S. could still maintain control of them?
Some of that has been onshored more by emerging market countries. Very difficult to track, but we do expect that trend to continue from many EM central bank players. And keep in mind, it's not just the PBOC and Russia that have been buying gold over the last decade. Yep. It's Poland, it's India. Even within developed market Asia, Japan and Singapore have been two of the largest gold buyers in the official sector sense since January 21.
You used the phrase that I think a lot of guests still shy away from. You said de-dollarization. Why are people so afraid of that phrase? What does that mean to you?
I don't think everyone is afraid of that phrase, but it is a concern for U.S. policymakers as people look for alternatives outside of the dollar. And if you look at Russian sanctions regime since 2022, gold as a bearer asset was the one instrument that they could hold, which they held onshore, that really couldn't be touched. Yes, you can push Russia out of the LBMA market and give them less liquidity to the Swiss refining centers, but they still have that asset, right? So I think from that point of view, challenging the U.S. dollar and the hegemony of the U.S. is probably a goal of some emerging markets, and we see that as a long-term trend.
Is there a limit to the amount of gold that central banks can hold on a relative basis to their reserves?
You'd have to ask central bank reserve managers. I think from that perspective, right now, the incremental gold holdings have grown. Right now, they're representing somewhere around 25% of annual gold mine production. As that number incrementally increases, that is price supportive. We think it does two things. It lifts the price floor of gold, and it damps downside price volatility. And that's why I think we're in a new regime shift, and dare I say, it could be a multi-year, multi-decade regime shift.
This conversation feels incomplete without introducing Bitcoin. Where does Bitcoin fit into this? Is it a competitor to some of the forces that you're talking about that underpin and support gold?
On the retail side, we see crypto as part of the alternative fiat story, particularly with retail investors. From a central bank or official sector standpoint, we don't view crypto and Bitcoin at Citi as digital gold. We view that as an alternative or a separate asset class. I think gold holdings increasing from sovereign wealth funds and central banks, what it does is it proves the validity of gold in the monetary system. And gold is old and traditional money. So we think crypto is a little bit newer. That's happening more on the alt-fiat side for retail. I think the official sector demand story is still driven by gold.
Is retail catching up to the gold story yet? Am I about to see tons of gold commercials? You know, like, we'll buy your jewelry, we'll buy your jewelry. How far away is that?
Well, it happens a lot on certain networks that you might not be watching late at night already. Certainly, maybe not Bloomberg. But within that context, yeah, I think so. I mean, you've seen the headlines about Costco selling out of gold bar and coins during specials, about young millennials doing stacks of gold bars as opposed to sat stacks on Bitcoin. So sure, I think it is becoming something that retail could get more interested in. Interestingly enough, John, ETFs have still posted outflows.
Interesting.
Since 4Q20, the all-time peak, you've seen 20 tons a month of ETF outflows on average. Imagine if that just flatlines or starts to increase. That tightens up gold physical, and I think that helps accelerate the move to $3,000 an ounce over the next 12 months.
I enjoyed this. We should do it again. A reference there to lowbrow financial news networks as well. Coming up next, Dana Peterson of the Conference Board. Their conversation coming up shortly. Akash, thank you. From New York City, this is Bloomberg. Equities with a bit of a bounce going into the opening bow, 60 minutes away. 3-day losing streak on the S&P 500, positive here by a little more than 0.25% on the morning. In the Nasdaq, we're positive by 0.2%, and the Russell doing a little bit better, up 0.4%, but the Russell has been difficult since the highs of March. In the bond market, new highs for 2024 on a 2-year yield and a 10-year yield over the last few days. 465.52, really close to 470 in yesterday's session. Yields backing away just a little bit, down a single basis point on a 10-year, on a 2-year, down 2 basis points, 496.42. And Lisa once again breaching 5% in the last 24 hours.
There are people who are kind of circling to buy, but it seems like they're not showing up in force just yet because there isn't that conviction that inflation is really going to get under control. And underpinning that is this question of how much does the equity market have to crack to get bonds under control, to get inflation under control, to get the Fed to actually cut rates.
And how much does this dollar need to rally to cause some big problems worldwide? The good news for those of you worried about that is that on the session, the dollar is weaker against, I think, pretty much everything in G10. The euro is positive by 0.1% at 106.33. The yen is showing the smallest bit of yen strength against the dollar at 154.67. And cables at 124.50, positive by 0.2%. Earlier this morning, Lisa, as you know, inflation in the UK just a little bit hotter than expected, but still the BOE expected to cut sometime soon.
They don't have the luxury necessarily of allowing inflation to run hot while also supporting the economy. But that seems to be what they're working at right now, is that they're looking at a lot weaker growth and inflation, as we were pointing out earlier today, still below where we are in the U.S. So it might be hotter than expected, but still the U.S. is looking more inflationary right now than the UK.
Yeah, and Europe and the UK, and you said it, just to not have the growth profile of what we're seeing play out here in the United States. That's the FX story. Under surveillance this morning, our top stories. President Biden calling for new 25% tariffs on Chinese steel. The move only targeting a small segment of the US market, just over $1.7 billion worth. Biden making a campaign stop in Pittsburgh today to reiterate his call for US steel to remain American owned. We talked about this hours ago. This is messaging, and it's messaging for the campaign trail. It's messaging going into November.
Absolutely. This is on cue for November, not about how they feel about steel when it comes to putting steel in the United States, given how small and minute this is in terms of the demand. But this sets the stage for potentially what we're going to see in some of the policy levers the administration can pull before the election. So it's going to be these tariffs on China when it comes to steel. We're waiting on potentially more tariffs when it comes to EVs. And then, of course, the Strategic Petroleum Reserve. It's tariffs and potentially putting more oil into the market, keeping gas prices down, talking tough on China. In swing states, this is what matters.
So it is politics. It is ahead of the election. But it is also policy. And I really just, again, we talk about geopolitics. They are more and more intricately intertwined with the economic backdrop and this question of what do you want the economy to be? You talk about free trade, the idea that the U.S. is trying to say, OK, someone's not playing by the rules, so we've got to play by their rules, and we're going to adopt some of the same kinds of measures. And what that looks in a holistic policy level and how that does not contribute to inflation is something that's kind of this circle that we're trying to square.
Yeah, Lisa, I think you're absolutely right. I think what we've seen under this administration, and we saw it in the previous one as well, national security concerns, and they seem to cover a lot of things right now, seem to come before any economic ideas you have. It's been interesting to see the progress, the journey that someone like Secretary Yellen's been on, coming out of the Federal Reserve with very specific views, I would say almost establishment views, old school establishment views about global trade, having lower tariffs, to go almost in complete reverse, a full 180 for the Treasury Secretary to really put at the forefront of her concerns national security issues. And that's not what we heard at the start of her term at Treasury.
No, she's really started to migrate towards the Jake Sullivans in this administration. And I think the quote she gave to the Wall Street Journal before she went on that most recent trip to Beijing, talked about in the past, you know, you get something free or a discount, you'd send a thank you note. She says, I'm no longer sending a thank you note.
We'll hear much more from the Treasury through the week. Of course, the IMF World Bank spring meetings kicking off this week. Elsewhere, Boeing under scrutiny at two separate Senate hearings today, one including whistleblower testimony. Senators calling on safety experts to address gaps in the plane makers' assembly processes. Boeing executives won't be present at either hearing. CEO Dave Calhoun expected to testify at a later date. Talk about messaging and bad optics. That's coming up a little bit later.
Yeah, they don't have the current CEO there, and they're not sure who the future CEO is going to be. And as we heard earlier this morning, this is mostly theater at a time where there still are a lot of questions around what actually happened. Honestly, I'm actually more curious about what people are questioning them about in terms of what we don't know yet, given how long this has gone on and the fact that fact-finding should be kind of number one, and it's kind of amazing we haven't gotten further.
This is all going to be, as Sheila and you were talking about, backward looking. Although I think a lot of senators are probably going to want to try to figure out who the next executive is to try to clean up some of this culture. But future-looking, Ryanair is talking about the fact that they said Boeing's taking steps to accelerate jet deliveries. So they're pretty excited this morning, if you look at what Michael O'Leary is talking about, that they're going to get 2 or 3 additional planes before the end of June. Pretty important for peak summer travel.
If you're scared of flying and you're flying later, maybe with Boeing, don't listen to that whistleblower testimony a little bit later today. The details of that, it's pretty frightening when you go through the details of those allegations.
Yeah, just complete lapses. And safety protocol, we talk about new technology. How about the technology of tightening some of the bolts and making sure that somebody oversees that tightening? These are some really difficult moments for them. I think the takeaway for us who fly is that planes might be older. You might not have the same kind of capacity. And it's going to have a real ripple effect because Airbus can't reduce production quickly enough to offset what we see from Boeing.
Expecting a pretty strong defence to come from Boeing. Once you hear more about that a little bit later. Elsewhere, Fed Chair Jay Powell putting rate cuts on ice. Powell saying yesterday, quote, the recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Today, we'll get more Fed speak, Mester and Bowman, plus the Beige Book coming this afternoon. Joining us now to discuss is Dana Peterson of the Conference Board. Dana, last time we spoke, we talked about CEO confidence and the survey that you do. And I want you to help us understand whether those CEOs are moving away from hoarding and towards layoffs or whether that's changing.
Well, we haven't had an update since the first quarter. We will get another one in a few weeks. But in that data, it suggested that, yes, there was a move upward in the number, or at least a percentage saying that they were looking to lay people off from 13% to 23%. That's a 10 percentage point differential. So that's pretty significant. But we still see a lot that are hoarding. So the key thing will be whether or not CEOs still think that there's something bad headed for the economy. But certainly they're still complaining about labor costs being elevated and the concerns about having to raise wages to hold on to workers and also to attract new workers, especially in those sectors that are experiencing labor shortages.
These are really important conversations for a whole host of reasons, including consumption. Let's turn to consumption. Dana, can you talk to us about what is underpinning consumption and how sustainable you think some of those trends are?
Sure. Well, definitely seeing that goods consumption is starting to weaken. Even though the retail sales overall were elevated, most of it was in prices. Take away the prices, in real terms, retail sales are actually down in the first quarter. But that's still not affecting services. Consumers are still willing to spend on vacations and various types of items. The interesting thing, though, is that they do desire to shift services consumption more to things that they need, like health insurance and car insurance, and less towards those highly discretionary activities like entertainment outside of the home. But still in all, what's underlying consumer spending is the fact that they're working, they're still fairly optimistic about the current situation with their jobs. And many of them have seen wages rise. And also lots of them are still using those credit cards and buy now, pay later schemes to finance their consumption patterns.
Dana, how much has the strength in equity markets, in bond markets, fueled some of the consumer spending?
Well, most consumers don't own any equities, but they do kind of internalize what's happening in the equity market for themselves. They see that if the equity market is doing well, most likely they're going to continue to be working, and that's going to continue to allow them to spend. Even if it's not out of earned dollars and they're putting it on credit cards, they still believe that they'll have the capacity to pay back that debt. So certainly a better equity market and continued gains does support consumer confidence.
The reason I ask is because people have been talking about the pivot back in October, November, December by Fed Chair Powell, talking about the potential for cutting rates, really keying off this latest bout of strength that has persisted and really caused and allowed inflation to remain higher for longer. Do you adhere to that view that essentially it was the Fed's pivot back late last year that has allowed inflation to remain as hot as it has and allowed consumers to keep spending as they have?
Likely not. When we ask consumers what they're planning on buying, especially big durable goods that you need to finance, they're not really excited about it. They're buying fewer homes, cars, appliances, even things like cell phones. Certainly when the Fed pivoted and said, look, we're done raising interest rates and we're looking, the next action will probably be rate cuts, you did see mortgage rates fall. But since then, mortgage rates have picked back up. And certainly we're not seeing broad-based consumption of housing. It's really on the margins and mostly for new homes, but existing home buyers are still on the sidelines. So I don't really see that the gains in inflation are because of the Fed. Indeed, when you look at what's driving inflation, or at least keeping it sticky, a lot of it's supply side factors like food and energy prices. Also, the fact that insurance companies are raising their premiums, and that has to do with technology changes and also climate issues. But really the big portion of inflation is housing and shelter costs, and that's continuing to slow year on year, and the Fed did have a role in that. So I would have to disagree with the thought that the Fed pivot, quote unquote, back at the end of last year is causing inflation to be stickier now.
There's also this question of the overlay and the overhang of oil prices and oil at a time when we're potentially heading into the busiest driving season, as well as the busiest geopolitical cross-current moment that we've seen in a very long time. How are you factoring in gasoline prices in the U.S. at the highest levels going back to October? The fact that we're seeing oil prices hover around $90 a barrel, this idea that it could reach $100 a barrel. How are you gaming this out with respect to confidence, but also just corporate activity?
Well, we have to raise our inflation forecast for the headline because this is a classic case of insufficient supply and emerging demand. We're heading into the peak driving season in the U.S. Meanwhile, OPEC Plus has pulled back on production. In the U.S., we're having issues with shortages of energy, certainly in the strategic oil reserve. And also, when you think about the energy sector, there's not much investment going into fixing refineries. And so a lot of things are breaking. A lot of the equipment's old, and that's also affecting supply. So when you put these things together, it suggests, yes, we are going to see higher gasoline prices over the next few months, and we're going to have to factor that into our forecast. The question is whether the Fed looks through that. And I think the thing is that the Fed really can't look through supply issues anymore because supply has been such a big factor in what's been driving inflation, even away from the interest rate hikes that they've implemented that have helped to affect the demand aspects of inflation.
How much is geopolitics and all of this risk weighing on executives?
Oh, it's definitely an issue. In our CEO confidence survey from the first quarter, the thing that they thought was the most strenuous or the worst risk for both the global and the U.S. economy were geopolitics. And it's the uncertainty around that. And indeed, how these things will affect supply chains, prices for inputs such as chips and energy. And these things are really causing our executives to be very worried about the future and potentially causing them to kind of resist big investments in areas that they don't think are going to be very productivity enhancing.
You question whether or not the Fed can look through the spike and the rally we are seeing in commodities, specifically the oil market. What is the gap? How much is it in terms of, say, $10, $20 on Brent that they actually start to get very concerned?
Well, I think the Fed's concerned now. Certainly, Chair Powell said yesterday, look, we may need to wait longer for that, quote unquote, confidence, and suggest that, well, maybe 75 basis points of cuts are really not feasible for this year. So I think the Fed is already concerned about this. They're looking ahead and they're saying to themselves, it's not really clear that we're going to see the constellation or the the perfect constellation of data that will allow them to have that confidence to start cutting interest rates before sometime in the summer.
Dana, this was great. When the new survey comes out, let's catch up. Looking forward to that. Dana Peterson there at the conference board. Appreciate it. Thank you. This from Citi's Andrew Hollenhorst moments ago. Powell wants to cut. Here's a line. Interesting take. Just 40 basis points of cuts priced for 24. Underappreciates that the Fed is poised to cut rates on either slower year-on-year core inflation or any signs of weakness in activity data.
So basically, see that bar? Let's lower it here.
Yeah.
Now let's lower this here. Hey, it's down there. That's fine. We can cross it. That's essentially what you're saying. And frankly, that coheres with the pivot. I go back to Alicia Levine. Can he pivot from the pivot? It makes a pretty awkward situation.
I found it difficult to keep up, but it's sort of later in the morning. But yeah, I get it.
It's like,
pivot from the pivot.
Yeah, pivot,
Right.
like you had to get back and up and,
Got it.
A pivot is a U-turn, no?
That's what I thought too. Why don't we just call it a U-turn?
Well, it's because it's sudden and it's sort of jarring to the markets.
Okay.
U-turn is sort of a very deliberate kind of act.
Right, and this, okay, all right. Let's get you the Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Tesla will ask shareholders to vote again on its compensation package for Elon Musk. This after a court in Delaware voided the $56 billion payout arranged for the company's CEO back in 2018. In a proxy filing, Tesla also said it will also call for a shareholder vote on moving the company's state of incorporation from Delaware to Texas. Senator Bob Menendez is preparing to blame his wife at his bribery trial. Court documents show Menendez will claim his wife Nadine withheld information from him about gifts the couple allegedly accepted from businessmen and the Egyptian government in exchange for favors. Menendez's legal team is trying to get a judge to try him and his wife separately. In an interview with Bloomberg, JP Morgan Chase CEO Jamie Dimon makes no secret that his firm is all in on artificial intelligence.
It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. Like, AI is doing all the equity hedging for us for the most part. It's idea generation, it's large language models.
You can see more of Emily Chang's interview with Jamie Dimon on The Circuit tonight at 6 p.m. New York here on Bloomberg Television, or stream it at 8 p.m. Eastern on Bloomberg Originals. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Congrats to Emily again. That's a must-watch a little bit later on. This from Dan Ives of Wedbush this morning on Tesla. Yahara was talking about it. In our view, the clock has struck midnight for Musk to now lay out the growth strategy, give realistic delivery and margin goalposts, discuss why significant layoffs now, and most importantly, give a clear outlook to the street around Model 2. He's been talking about this inflection point for Tesla for how long now? He's still got an outperform on the stock.
Well, this is the reason why I'm wondering, is this inflection point the one where he's going to say, I no longer am bullish on this stock if you don't deliver?
After a 30-plus percentage point move so far year to date, I mean, how much more do you want to see?
Well, and this is the question. This is their moment. It's midnight. Well, what comes after midnight?
I'm pretty sure it's gone midnight. I mean, he's been talking about midnight now for 6 months, hasn't he?
Come on the show, Dan, and we'll talk about it.
We'll talk about what time it is. Tesla right now positive by 0.6%. Up next on the program, President Biden's latest pitch to U.S. workers.
This isn't a level playing field. And when the markets weaken, prices fall. It's our firms that go out of business.
That conversation just around the corner. Your opening bell is about 43 minutes away. Equity futures positive by a third of 1%. Things are better. If you thought it was a problem that crude was higher, it's lower this morning. We're down 1% on WTI. WTI right now 84.44. If you were worried about higher Treasury yields, they're a little bit lower today, down 2 basis points, 464.48. And if you're concerned about a rip-roaring dollar, that's a little weaker. The euro stronger, 106.37. These are mild moves, Bramo, but certainly moving in a different direction compared to what we've seen dominate the last week.
It's snoozy. No one has new information to do anything with this morning. Essentially, that's what we're looking at after a reset yesterday and a reset the day before. And that's what we're feeling right now.
I'll take snoozy. Just a break sometimes, a good thing. We all need one. Under surveillance this morning, President Biden's latest pitch to U.S. workers.
This isn't a level playing field. And when the markets weaken, prices fall, it's our firms that go out of business. Chinese firms continue to receive support so that they remain in. From a supply chain standpoint, I think it creates risks that we're clearly seeking to mitigate, and it's also unfair to our workers and firms.
So here's the latest. President Biden proposing 25% tariffs on Chinese steel and aluminum. The news coming ahead of his visit to Pittsburgh this afternoon, where he'll meet with workers and reiterate the US steel should remain American-owned. Joining us now is the brilliant Mario Parker of Bloomberg down in Washington. Mario, let's talk about that visit to steel workers. What can we expect to hear a little bit later?
We're going to hear, John, a whole bunch of a heavy dose of populism, right? This was a signal ahead of that visit to herald to steel workers that Biden is there for them, that he's pro-union. A popular refrain in his stump speeches is that he's the most pro-union president in U.S. history. But we know that he faces a tough slog with a rank and file with his political rival, Donald Trump, really appealing to that demographic.
Mario, we know that Catherine Tai, the U.S. trade ambassador, is nearing completion of the statutory review of the Trump-era tariffs. We all agree around this table, and I'm sure you do in Washington, that this is purely political when it comes to what Biden is going to be doing when it comes to Chinese steel. Would we actually see it come to fruition before November 5th?
We may, Annmarie, and we're on high alert just for the outcome of that investigation there with Catherine Tai. But no, we're on high alert for that here in Washington, D.C. I mean, listen, what we're seeing right now is just the landscape of the 2024 election. There aren't many, to your point, there aren't many Chinese steel and aluminum imports coming into the U.S. relative to previous years because President Joe Biden kept Donald Trump's tariffs in place, largely kept those in place. So what you're seeing is him essentially squeezing the lemon here for whatever modicum or small amount of imports still exists. But also, similarly, he's squeezing the lemon there because he needs as many votes as possible in a crucial swing state like Pennsylvania.
But there's also going to be potentially more sanctions, not tariffs, but sanctions when it comes to Iran. We heard from Jake Sullivan last night talking about the United States is looking at what more they can sanction. Mario, there's a statement there. What could the U.S. sanction? This is one of the highly sanctioned countries in the world.
Yeah, well, you're saying Sullivan say that essentially that they're going to target the missile apparatus, some of the aircraft that was used, the technology behind the aircraft that was used in the drone attack that the U.S. largely helped Israel thwart and its allies thwart last weekend as well. And so you're saying them kind of target that specific sector. But to your point, Annmarie, similar to the other subject that we just mentioned, I mean, Iran is already heavily sanctioned.
Mario, to that degree, we're hearing from Israeli Prime Minister Netanyahu this morning. Thank you for the suggestions, but no thanks. We'll take care of this ourselves. How much are you seeing an ongoing breach that actually does have some consequences from the United States against Israel if they do go after Iran more directly versus a bit of a walk back from the administration over the past couple of days?
Yeah, well, we've seen the administration quite publicly put pressure on the Netanyahu, some of his leadership, just asking for cooler heads to prevail, essentially saying, okay, we were able to thwart this attack. Let's not escalate things in the region. Now, to your point, I mean, the frustrations between Washington, the Biden administration in particular, and Netanyahu you can't really overstate just how tense those moments are right now.
Mario, I appreciate the update, as always, sir. And we'll see you a little bit later in Washington, D.C. Mario Parker there of Bloomberg. In the nation's capital, coming up tomorrow, live from the nation's capital, special Bloomberg Surveillance over the next couple of days at the IMF World Bank Spring meetings. We'll kick it off with Alifa Doriwala of Rock Creek, IIF President Tim Adams, Klaas Knot, the President of the Central Bank of the Netherlands, and IMF Managing Director Kristalina Georgieva. Later on in the week, we'll be speaking to Catherine Tai herself, so a lot to talk about on trade. And Lisa, I know you're catching up with Gita Gopinath of the International Monetary Fund.
They did upgrade their growth forecast going into this with a whole host of risks coming around this. To me, I'm actually very curious how they view an economic regime so heavily influenced by politics, where suddenly this is a multipolar world, as we've been talking about extensively, where economic policy is political policy, is geopolitics, and does not look like the free trade of the past.
Also, a very strong criticism from the IMF when it comes to the United States and their fiscal health of this country. Yes, all the fiscal money coming out the door potentially helping with American exceptionalism, but are they ever going to deal with the debt problem?
Time to get to the train station, isn't it? You know, we're all going together.
Okay.
No?
Only one of us is taking the
Get the train. What are you talking about? Always get the train.
Me too.
They're not.
Always get the train.
They're lying to you.
Why would we lie about
John
it?
and Lisa are lying. I'm the only one that's
I
taking
always
the train.
get the train. I'm very sort of pro saving the planet and getting the train down to Washington.
Is that your theory?
Yeah.
You know, actually, it's always a toggle for me. It saves an hour, but if everything goes wrong, which is more likely to do for a plane, I don't know. These things are not really.
I don't like how transient trains are. You know, if I'm really off. You know, people getting on and off. Just like, you sit on a plane, get to where you need to go, get off the plane.
So you want to get used to everyone around you, so that you just you're trapped together for a certain period of time.
Are you flying window or aisle?
No, I'm pretty sure I'm aisle.
Lisa?
I think I'm aisle.
I don't know. I'm not keeping track. I'll see you tomorrow in DC.
Transient trains a thing, you know, like you like
I like
on
it.
and off.
I think it's good color.
So you've got one eye on your bag, just making sure the bag's
it's new
not being
ideas.
stolen.
Oh my God.
You know,
really?
It's rough out there.
Oh, give me a break.
It's dangerous.
It's ridiculous.
You've got to be careful. People steal your bag.
Who are you?
It's a real thing.
Has that happened to you?
Train theft is a
Have
real
you
thing.
ever had something stolen
No,
from you?
because I keep an eye on my bag.